Good morning. And if you can remember, on the first day when we started our CS Executive CMA paper, I had told you on completion of the entire syllabus, we'll solve the previous examination question paper to check as to whether we've done the entire syllabus and how much of it do we know, and definitely to boost our confidence. And here we are. We did finish our entire syllabus yesterday, and today I'm going to take you through the entire December 2019 CS Executive Corporate and Management Accounting New Syllabus, the only MCQ paper, and we're going to solve all the 100 MCQs in the class so that you will know whether we've done the syllabus and to what extent do you actually remember the syllabus. Yes, so without wasting much time, let's get started. So this is how your question paper will look when you take it in hand whenever the exam is being conducted. And you have a question paper booklet number, so you need to write this question paper booklet number in the OMR sheet and OMR booklet number in the question paper. And you gotta use only and only black or blue ballpoint pen, not a gel pen, not an ink pen. So that's something that you gotta note. And there is a set of instructions given to students. I'll tell you a couple of important ones. First one is about writing the question paper booklet number in the OMR sheet and OMR booklet number in the question paper sheet. And question paper booklet will be different for each of you. The code, this also needs to be mentioned in your OMR sheet. And next one is you can use only black or blue ballpoint pen. And lastly, you cannot do your working notes where and ever you want. Like you have to do working notes only at the specific place wherever it is provided for working notes. So meaning, if this is the question paper, you've been provided place here to do working. So you do it only there, or at the end there are like couple of pages where you got to do, and you should do it only there and not everywhere that you want to. Yes, and no marking is allowed in the question paper other than what to say the working space place, and you can only mark the answer there, ticking, put an into mark, and other things are not covered. So these are basic instructions. You should be aware, and let's get started. Come on. First question. Mines as an asset is an example of what? Mines are natural resources. Mines are called as vesting assets. So these assets will be depreciated very differently. So the method of depreciation that we're going to use is called as depletion method. And are only mines wasting assets? No. There are quite a lot of other wasting assets also. Maybe like oil wells, coal reserves, and what to say any other item which is natural in character. Come on, let us go to the next one. At the time of preparation of balance sheet, capital work in progress is shown where? Okay, whenever there is a capital work in progress, it cannot be regarded as a liability, as it is what is says capital item being constructed. Now when there is a building that you basically building that building, it is not an asset ready for economic consumption, or it will not reap economic benefits immediately. But that will not take the character of that item away. It's going to become an asset in the future, and that particular asset is yet to become a fixed asset. But it cannot be considered as a current asset as of now, so it would always be considered as a fixed asset, irrespective of the fact whether it is completed or not, because it is intended to become a fixed asset. So this is called as a non-current asset. So it would be regarded as a non-current asset along with the item that it's going to become very soon. Even a half-built car is like a car. Yeah, come on, let's get going to the third one. So as per ICAI guidance note, at the end of the year, balance of share options outstanding account should be transferred to where? We have discussed this in the chapter of ESOP, employee unit, what we discussed in the chapter of share capital, and also discussed this a little when we did valuation of share-based payments in 40 marks part, the last chapter. So in both the cases we told, whenever the organization intends to give shares at a price lesser than the market price to employees, it starts keeping certain money aside every year, and at the end, if number of options exercised is less, meaning employees' options got lapsed either because they left the organization or because they didn't buy it, they didn't exercise their option. In such cases, the existing provision created, which is in excess, it will be transferred to reserves and surplus and not P&L account. Why not P&L account? Because it is not the current year income. It is the excess expenditure charged in the previous year leading to excess in the provision. If it is reversed and transferred to current year PL, it will increase current year profit, which is wrong. So it will be transferred to reserves and surplus. So we have discussed this. Yeah, you can go back to our class notes and then read this part if you find it a little difficult. Come on, let's go to question number 4. Question number 4 talks about Shiva Limited forfeited 4,500 equity shares of rupees 10 each. So this is a question from share capital chapter, and if we can read the last line of the question first, that will help us understand what exactly should we do. If not, we might end up reading the same question more than once, which is actually a waste of time in the examination. Come on. So what amount should be credited to share forfeiture account? So if we can recall, we had discussed something called as super duper working note, wherein we basically identify 3 items. Yep, amount called up, amount paid up, amount unpaid. Amount called up should be reversed to share capital account. Amount paid should be transferred to share forfeiture account. Amount unpaid should be reversed to call scenarios account. So with respect to this, amount called up will be reversed to share capital, will be debited. Amount paid up will again be, it is a money which was received, which is no more supposed to be returned. So it will go to credit of share forfeiture account. Here what they are basically asking is amount to be transferred to share forfeiture. So what is the amount that is supposed to be transferred to share forfeiture? That is amount paid up. So with respect to those shares which are forfeited, we got a check as to how much was the money which was previously collected. That money, whatever is collected, will be transferred to share forfeiture account. Yep. Let's get started. Let's start reading. So a company forfeited 4,500 shares of rupees 10 each, which were issued at 40% pro-rata basis. Okay. So there is a pro-rata application. You remember, a happy situation to the company. I'll write it like this: applied, allotted. So 40% is the allotment. So if someone had applied for 100 shares, okay, 100 applications will be allotted 40 shares. 100 applications will be allotted 40 shares. Let's continue reading. What is happening? Shares are of rupees 10 each. Okay. Share of rupees 10. Non-payment of allotment money of 6, including 2.5. Okay, concentrate. There are 3 things here: application, allotment, call. So on call, it is basically 3 rupees. This share is 10 rupees plus there is premium of 2.5. On allotment, you are collecting 6 rupees. In that, premium is 2.5. Totally it is 6. So if I do 6 minus 2.5, I'll end up with, very important, don't take a chance in the exam, do it normally, 3.5. So if you take 12 rupees, 12.5 as the share value, you subtract 9 and you will arrive at 3.5 rupees towards application. Or if you take 10 rupees per share, you can subtract 3.5 and 3, that is 6.5 subtract, you will get 3.5 towards application. So with respect to this share of rupees 10, 3 rupees 50 paisa is collectible on application, 6 rupees is collectible on allotment, of which 3.5 is towards nominal value, 2.5 is towards premium, and balance 3 rupees on first and final call. Okay, what is happening in the question? And he failed to pay the allotment money. Did we read that? Okay, he failed to pay the allotment money. Allotment money was not received. Allotment money was not received. Yeah. So and when the allotment money is only not received, will we further go to make call? No. Only application money is received. You get that? So when you don't pay the allotment money, you will not ask them for the call money. You stopped it there. So what is happening? If the excess money received on application is used for receiving the amount due on security premium. Very important statement. If the excess money received on application is used towards, if this statement was not given in the question, our treatment of the answer would have been different. Okay, I'll explain this statement to you by referring to the first part again. Shiva Limited forfeited 4,500 shares. How many shares were forfeited? 4,500. Now you got to tell me that that guy whose 4,500 shares were, I would say, forfeited, had he applied for 4,500 shares? Definitely no, because the company is going for over subscription, and it went for pro-rata allotment. So that bad boy here who didn't pay allotment money would have applied for more than 4,500 shares, and he was allotted 4,500 shares. Now the question is, how many shares did he apply for? You get that? Now why should we do this? Sir, 4,500 shares are forfeited, against which 3.5 is collected. So 4,500 into 3.5. Can I do that as my answer straight away? The answer is no. You can't do it upfront that way. Because what you need to remember with respect to this particular shareholder is, he might have applied for way more number of shares than this particular amount of 4,500 shares. So with respect to that, he might have paid little excess money than application. You get that? Yes, come on. So let us go ahead and then check as to how much money, how many shares had he applied for previously. 4,500 shares are allotted to him. Yes? How many would have he applied for? See, if it is this much for this much, how much for this much? Yeah, itne mein itna to itne mein kitna? Ishtake ishtadre ishtake estu. Intaki intaite intaki yenta. Divided by 40. Yolokko yolona yolokko yolo. 11,250 applications. So basically this guy would have applied for how many applications? 11,250 applications. Now this guy would have paid on application. On application, how much is something that we would have received? We would have received 11,250 applications multiplied by 3.5 rupees. Multiplied by 3.5 rupees. That gives me 39,375 rupees. But how much is my application money? Actually, I have allotted him 4,500 shares only. So I'm supposed to collect 4,500 into 3.5. 4,500 into 3.5. So 15,750 is what I'm supposed to collect. You get that? Anything excess collected is towards what? Share, would say, okay, how much is the excess money collected? Let's first find out the excess money collected. So minus 39,375. That takes me to 23,625. This is the excess money collected. Now on allotment, what they're telling is this money will be used against my premium. Let us first calculate how much is the premium. If premium money is lesser than 23,625, that excess money received will be adjusted against share allotment. If premium money is greater than this, then no problem. You get that? So let's see. How much is the premium exclusively? On allotment, premium is 2.5 into 4,500 shares. So if I do 2.5 into 4,500 shares, that is, 4,500 shares into 2.5, that is 11,250. Yeah, and then how much is the money towards allotment that is supposed to be called? We are supposed to receive 3.5 rupees into 4,500. Am I right? Yes, come on. So let us do this. 3.5 into 4,500. That comes to 15,750. So in total, how much am I supposed to collect? Receivable on allotment is 15,750 plus 11,250. Together comes down to 27,000 rupees. You get that? How much is the calls in advance that I already have? Yes, calls in advance that I already have is 23,625. So how much is the money that is calls in arrears or not received now? Minus 23,625. That comes to 3,375. Now this money is not received out of premium or not received out of allotment is our present question. You got what I'm trying to tell? This 3,375, what is not received, is it not received out of premium or is it not received out of allotment? This is our question. Let us read this question once again. Very important. A lot of us might solve this question completely wrong without understanding the significance of this underlined paragraph. If the excess money received on application, what is this excess money received out of application? 23,625. What are we going to do? Is used for receiving the amount due as securities premium. It will be adjusted against this security premium. So 23,625 may I'll adjust 11,250 first. So after adjusting 11,250, whatever is remaining, against that we'll adjust it later. So the first priority is premium, second priority is towards allotment. So basically this 3,375 is not collected out of 15,750. You get that? And if I have to summarize the entire thing, or if I have to start answering this question to you, basically how much is the amount collected? Yeah, amount collected on application is 39,375. On allotment, you didn't collect anything. Then you didn't collect anything. But out of this 39,375, what is collected? How much of it? Basically, on application, you are supposed to receive 15,750. You have received 15,750. On allotment, you are supposed to receive 15,750 again. But out of the 15,750, what you are supposed to receive on allotment, the 3.5. Yeah, out of the 15,750, what you are supposed to receive, you didn't receive 3,375. So I'll subtract 15,750. Say 3,375. I'll end up with 12,375. This is the money that is already collected by the person, and this is the amount that is received. This will be adjusted against our, this will be transferred to our share forfeiture. If I add 12,375 and 15,750, I'll end up with the answer 28,125. So the answer is 28,125. This will be transferred to share forfeiture account. So the answer is 28,125. I'm trying to tell you, this is a tricky one. People usually pounce on the answer and then tell 15,750 as the answer. People usually pounce and then tell 15,750 as the answer. But that is not the answer. Because a lot of what they say is, sir, application money is received, allotment money is not received. Allotment money is not received. So what do we do? 3.5 application into 4,500 shares, and we multiply whatever the answer we get. We say amount received transfer to share forfeiture account. Remember, amount to be transferred to share forfeiture account is amount paid up. Amount paid up. How much is paid up? They paid me 39,375, meaning they paid complete application money. Excess money received on application 23,625 will be first adjusted against premium. After adjusting against premium, what is the money that I have received in excess that is used for the purpose of our our allotment? Not complete 15,750. Out of 15,750 that is receivable on allotment, 3,375 is calls in arrears, not received. So out of 15,750, I will deduct my 3,375. Balance of 12,375 is received. So total money received is 28,125. Or I can tell you another beautiful shortcut to arrive at this answer. Simple. How much is the total money received? We have received 39,375. From this, I will subtract the money that is collected towards premium. How much is the money collected towards premium? 11,250. So 39,375 minus 11,250, that gives me 28,125. You get that? So this is verification for the answer. What is the verification? Total money received is 39,375. Out of that, 11,250 is towards premium. Balance money that you have is basically share forfeiture account. So the answer is 28,125 rupees, and this is supposed to be credited to share forfeiture account. Oh, sorry, it's already mentioned, so I need not worry much. So it's the amount to be credited to share forfeiture account. Yes? Come on, let us go to the next one. Sir, you took more than 10, you took about like 6-7 minutes to solve this question. So how would we be able to do it in the exam? Got to understand couple of things. Point number one, I'm not solving it as in the examination type now. I'm solving it in detail. In the exam, you need not write it so much in detail. You might do a lot of shortcuts to arrive at the answer. Point number two, I'm explaining it to you. And in the exam, you're not supposed to explain the answer to your friend or to your evaluator. You're just solving it for your sake and to arrive at the answer. You get this? Still, I'll try my best to ensure that the entire solution to the paper will not go for longer than 3 hours. Let's see. Come on, question number 5. So what exactly do you have in question number 5? Again, it's a question based on the forfeiture, as the name says. Let me read the last line so that I'll understand what exactly do they want, so that I'll do only according to what they want. Yeah. So this was question number 4. Okay, fifth one. What do they want? The amount transferred to capital reserve. What is the amount to be transferred to capital reserve? Excess money received on reissue. Yeah. If you can remember, we had discussed this concept. Previously, a share was there of rupees 10, against which paid up was 4 rupees. You get that? And you had called for entire 10, only 4 rupees was paid up. Remaining money was not paid. Then the minimum reissue price was 6. Meaning 10 rupees is the nominal value. You have collected 4 rupees from the previous shareholder. The balance money should be collected from the next shareholder. If in case the minimum reissue price is 6. Now if my reissue price is 7. So what is the minimum reissue price? 6. Actual reissue price 7. How much have I collected excess? 1 rupee. That 1 rupee will go to capital reserve. You get that? So we have defined this as to amount to be transferred to capital reserve is balance remaining amount collected over and above the minimum reissue price till the nominal value. If the reissue price exceeds the minimum reissue price and also exceeds the nominal value, to the extent it exceeds the nominal value, will go to share premium. Yeah, I'll repeat. Reissue price in excess of nominal value is security premium. Reissue price in excess of minimum reissue price will go to capital reserve. What do you mean by minimum reissue price? Nominal value minus paid up. How much ever is the previous paid up. So this is the concept that we had discussed previously. I just brushed it up for you here. You can go back to our class notes to understand it a little. Come on, let's go. P Limited forfeited 5,000 shares of rupees 10 each. Okay, shares are of rupees 10. This is question number 5. Shares are of rupees 10, against which non-payment of final call of 2.5. So final call, I'll write it as call. Call of 2.5 was not paid. Okay, issued at 3 rupees premium. This is none of our business. This premium of 3 would have been collected. If collected, you ignore. If not collected, also you ignore. So this is something which is which will have no impact on our answer. So don't touch that particular part. Or if you want, you can write it as tongues out. That information is not required in our answer. Yeah, receivable on allotment. Out of this, 3,200 shares were reissued. Okay, fine. We can say application and allotment will be 7.5, and 7.5 rupees is basically received from this particular share. So what is the minimum reissue price? Out of this 10 rupees share, 7 rupees 50 paisa is received. Very good. What is not received? 2 rupees 50 paisa. So if anybody is ready to pay me 2.5, I am ready to issue the share to them. So minimum reissue price is 2 rupees 50 paisa. Done. Let us get going now. Okay, what's happening? It reissued the share at 8 rupees. What is the reissue price? 8. Now tell me, does the reissue price exceed the nominal value? No. If reissue price was 12, so 12 is greater than 10. 2 rupees would have been security premium. In this case, reissue price is 8. So that is not in excess of 10. So the entire excess will be capital reserve only. So how much is collected in excess? You are supposed to collect 2.5. You collected 8. So if I do 8 minus 2.5, I'll end up 5.5. So amount to be transferred to capital reserve is 5.5. That is profit. This 5.5 is per share. Why? 8 is per share. 2.5 is per share. 5.5 per share. How many shares are reissued? Okay, we don't really care about this 5,000 shares being forfeited. What really matters here is how many shares are reissued. If there are certain shares forfeited which are neither cancelled nor reissued, with regarding those shares, will not transfer the money to capital reserve. That will remain in share forfeiture account till the time the shares are either cancelled or the shares are reissued. 3,200 shares were reissued. So I'll do 5.5 per share multiplied by 3,200 shares. So how much will I get the amount to be transferred to capital reserve? 5.5 into 3,200. That is rupees 17,600. So the answer is 17,600. Let us see the options. Question number 5. The answer is 17,600. It is option D. So we're done with the first 5 questions. In fact, we're done with the first stage of our question paper also that way. Yeah. So this is the solution to question number 5. If you want to copy, you can pause it and then copy. And now I'm going to question number 6. Come on, let's go to question number 6. Question number 6 again deals with numbers. Let us read the last line to understand what exactly do they want, so that we won't waste time solving things that we don't want. Yes. So read the last line. The amount received on allotment will be, again, issue of shares, share capital based chapter only. C Limited invited for, they asked how much money will be received on allotment. Okay. Amount received on allotment will be how much? C Limited invited applications for the issue of 20 lakh equity shares of rupees 10 each. Okay. 3 rupees on application, 7 rupees on allotment. Application were received for 35 lakh equity shares. Oh, excess of applications received. Shall I do this on the left side, the working? Okay, listen. Applied, allotted. Companies has received 35 lakh applications. So what did they do? Oh, they've rejected. 7 lakh applications are rejected. So out of 35 lakh, how many are rejected? 35 minus 7 I'll subtract. 35 minus 7. I'll get 28 lakh. So 28 lakh applications. So out of that, how many are allotted? They made pro-rata allotment to the balance. So basically, pro-rata allotment to 20 lakh. So 28 lakh applications, 20 lakh shares. Great. Next, excess application money received was allotted towards the adjustment. We are talking about Mr. Ravi. Mr. Ravi. Mr. Ravi, son, could not pay allotment money on his 2,500 allotted shares. He was allotted 2,500 shares. Now my question is, how many did he apply for? Sir, why should we find it? Because he might have paid excess money on application, which is adjusted towards allotment. Only the balance money which is not received is the point here. Done? So he could not pay the allotment money is 2,500 shares. Fine. Let us see. 2,500 multiplied by 28 divided by 20. So we got 3,500. 3,500 applications. Okay. So one part of the information that we basically need is done. So I'll go to the next line. Concentrate here. Applications were received for how many? 35 lakh. I'll categorize it into 3 parts. 1, rejected. How many were rejected? 7 lakh were rejected. And I'll write 1 as other shareholders. Okay, fine. Pro-rata was made for how many shareholders? 28 lakh? 28 lakh. Pro-rata allotment was made for 28 lakh shareholders. I'll write this into 2 parts. 2 parts of this is, one is Ravi, other one is others. Ravi holds how many shares? 2,500 shares. Others hold how many shares? 20 lakh shares, no? Out of that, 2,500 shares are held by Ravi. Remaining 19 lakh 97,500 shares are held by outsiders. You get what I'm trying to tell? 19,97,500 shares are held by outsiders and 2,500 shares are held by Ravi. Okay, so what has Ravi done? Ravi has basically paid the application money, but he failed to pay the allotment money. Now, let us see with respect to application, how much money is collected. On application, you collected 28 lakhs multiplied by our, how much? 3 rupees per share. Where is it given? Shares of rupees 10. 3 rupees application. 7 rupees on allotment. Perfect. So on application you received 28 lakh into 3. That is 28 into 3. So you received 84 lakh rupees. But on application what was supposed to be collected is 20 lakh into 3. Yeah. 20 lakh into 3. That comes to 60 lakh. So calls in advance here will come to 24 lakh. You have collected 24 lakh rupees in excess. So application stage is done. Now we'll go to allotment stage. Okay, at allotment stage you are supposed to collect for 20 lakh shares. You are supposed to collect how much per share? You are supposed to collect 7 per share. So that comes down to how much? 20 lakh into 7 is basically 140 lakh. Yeah, but out of that certain money you will not, certain money there is calls in advance. How much is calls in advance? This 24 lakh whatever is there is for 20 lakh shareholders. You get that? So 24 lakh is for 20 lakh shareholders. If I divide this 24 lakh by 20 lakh shares, so how much will I get per share? 24 divided by 20, that is 1.2 per share. So my calls in advance is basically 1.2 per share. I'll write this little below so that you will not get confused. Number of shares calls in advance per share is 1.2. Now let us go to allotment stage. At allotment stage, what is happening? How much is the money supposed to be collected? 20 lakh multiplied by 7, that is 140 lakh. Among this there is calls in advance. How much is the calls in advance that is there? Calls in advance is our how much? 24 lakh only. Entire amount will be adjusted up front. 24 lakh. And Ravi will not pay. Ravi will not pay allotment money. They have given Ravi could not pay allotment money. How much is Ravi supposed to pay? See, not just Ravi. Any person is supposed to pay 7. Out of that, calls in advance, what is already there is 1.2. So amount payable on allotment will be 7 rupees you should pay. Out of that 1.2 you would have paid in excess. Every shareholder would have paid 1 rupee 20 paisa in excess for each share. If I subtract 1.2 from that, 5 rupees 80 paisa is supposed to be paid on allotment. He will not pay 5 rupees 80 paisa. So I will do Ravi's shares. How many shares does Ravi hold? 2,500 shares. He will not pay 5.8. I will write 2,500 shares multiplied by 5.8 into 2,500. So I will get 14,500. This is lakh. Don't treat lakhs and this one on same. So amount, what is the amount received? Out of 140 lakh, yeah, 24 lakh is already received, so it will not be received, and 14,500 also further will not be received. So the answer will become 1 crore 15 lakh 85,500. This is the amount received on allotment. 1 crore 15 lakh 85,500. You get what I am trying to tell? Yes. So this is with respect to question number 6. You get it? So there can be an easier simplified version of this answer. Once you understood this, I thought I'll take you to that part. So what is happening is 3 rupees is collectible on application, 7 rupees is collectible on allotment. Out of, instead of collecting 3, you would have collected excess. If you just compute this exclusive, that part of excess money collected. So 1.2 rupees is received in excess. So if 1.2 rupees is received in excess, how much should be receivable? 5.8. So 5.8 per share is receivable. How many shareholders will pay? 19,97,500 shareholders will pay and 2,500 shareholders will not pay. So if I do 19,97,500 shareholders, that is shareholders other than Ravi, multiply them by 5.8 rupees per share and you will still get 1 crore 15 lakh 85,000. Correct or not? Ravi will not pay. Rest of them will pay, right? So the verification of the answer will be, we can multiply 19,97,500. We do it, right? So if I multiply this with 19,97,500 shares, multiply these two. If I multiply this and this I'll still get this as my answer. Yeah, other shareholders multiplied by how much of money collectible on allotment, I'll still get 1 crore 15 lakh 85,000. So this is with regard to question number 6. I'll show that answer part to you so that you can pause it whenever you want and then copy. So this is the first part of the working. And this is the next part of the working. So the entire thing is with respect to question number 16. Yeah, come on. Let us now, with respect to question number 6. Come on, let us now discuss question number 7. So question number 7 is also from share capital chapter. It talks about rule given under, company rules 2014. So rule number 17, what does it talk about? Rule number 17 talks about buyback of shares and other securities. We discussed this during our share capital chapter. Buyback of shares and other securities is something that's been spoken about in rule number 17 of company rules 2014. Yes, come on. Without wasting much time, let's now go to 8th one. 8th one is again based on our company law 2013. In case of buyback, passing the special resolution is not required. When is the special resolution not required? Special resolution is not required when the buyback is less than 10% of the paid up capital and free reserves. If the buyback is greater than 10%, then you would have to have special resolution. You remember conditions, technical conditions, legal conditions and accounting conditions. Yeah, so that's something with respect to question number 8. If the buyback of equity shares is greater than 10% of your share paid up capital plus free reserves, then you would have to pass special resolution against the same. If it is not, then not necessary. Yeah, come on. Let us go to question number 9 after this. Question number 9 talks about redemption of preference shares. For the companies whose financial statements are supposed to be complied under accounting standards given in section 133. So these are the companies who are covered under the bracket of section 133. If they are covered for the purpose of redemption of preference shares, if there is any premium, such premium can come only from P&L account. If the company which is not covered under section 133 is there, then it is not enforced by this particular provisions. You can do the same thing that we used to do in Companies Act 1956. Premium to be paid on redemption of preference shares can come from security premium. If you recall the discussion, I told you, if the company is covered under section 133 of Companies Act 2013, which talks about accounting standards, NFRA and all those things. So if the company is covered under these provisions, premium on redemption of preference shares should come from P&L account only. Sir, what if there is no sufficient balance in P&L account? Then you cannot redeem preference shares at premium. Sir, can I redeem preference shares at par? Then possible. Yeah, but in order to redeem preference shares at premium, you should have sufficient balance in P&L account. If the company is covered under section 133. If the company is not covered under section 133, you need not use P&L account. You can use security premium only to pay the premium on redemption of preference shares. Let us see. The premium payable on redemption of preference shares should be provided out of profits of the company only. Why only profits? Because the company is covered under section 133. What if the company is not covered under section 133? You can use security premium also. The answer would be actually C in that case, if the company is not covered under section 133. So this is again part of our share capital chapter that we discussed initially. Yeah, this is the answer to question number 9. Come on, let's now quickly go to question number 10. Yeah, CRR, you remember CAR, yeah, a boni, story of the boni. There it was very clearly told the order of items or the reserves, in which order can it be used for bonus issue. We discussed capital redemption reserve as the first reserve. Yeah, okay, car safely parking, car generally parked, bonus issue. If you have forgotten that chapter, please go back and then revise bonus issue. Yeah, we have discussed and then we've done a video on that also. So what exactly is our capital redemption reserve? Capital redemption reserve is capitalization of reserves. Ritik question, take it from the reserves, put it to capitals. It is capitalization of reserves. So capital redemption reserve can be used only for bonus issue and nothing else. Done? Whereas security premium has other uses, general reserve has other uses, P&L account has other uses. CRR can be used only and only for issue of fully paid up shares as bonus. Sir, can I convert partly paid up shares to fully paid up? You remember, small dog cannot jump the compound and then pee on the car which is safely parked, whereas a big dog pees on a car, CRR. If it is a small dog, car, you remember? Yes, and then if you can recall the bonus issue discussion, the capital reserve can be used only if it is realized in cash. Same is the case with respect to security premium also. Yeah. That's with respect to your understanding on bonus issue. So the conclusion is CRR can be used only for fully paid up shares as bonus and there is no other purpose for which you can use. We in fact did a case study also on this. I told you, Infosys, basically it went for buyback, and then whenever buyback happens, the capital reduces and they basically created CRR, and right after that they went for 1:1 bonus issue. We discussed in between that there was dividend also, how did the share prices fluctuate of Infosys in the last year because of buyback at 1:6 ratio, bonus issue at 1:1 ratio. In between there was dividend declared. Yeah, 750 rupees the price had come down to, it went up to 1,400. Forgot. Let's Let's go to question number 11. Question number 11 talks about, again, it talks about share capital chapter only because it talks about underwriting. So, what is it? What is the net liability of G if as per underwriting agreement, no credit is given to underwriter G for firm underwriting? Yeah, in the underwriting chapter, we basically discussed a couple of items. Number one, gross liability, that is a basic responsibility of the shareholder to sell. Second one, marked applications, applications bearing the stamp of the underwriter. Unmarked applications, applications not bearing the stamp of the underwriter. Firm underwriting, shares bought by the underwriter. Yeah, so basically we start with gross liability, we subtract marked applications. How do we subtract marked applications? Marked applications will be subtracted in that man, that share. If A has sold so many shares, subtract from A share. B has sold so many shares, B share we deduct so much. And with respect to unmarked shares, what do? Every person in the gross liability ratio. And then firm underwriting. How do we deduct firm underwriting? It depends on the circumstance, whether the benefit is given or the benefit is not given. If the benefit is given to shareholders, then what do? Then that firm underwriting will be totaled, will be deducted from that man, that share. Meaning, firm underwriting will be treated like marked applications. If what is happening, firm underwriting is given and the benefit is not given, then what would happen? We need to total the firm underwriting and then divide among all the underwriters in their gross liability ratio. Simple sense, firm underwriting, benefit given, treat like marked applications. Firm underwriting, benefit not given, treat like unmarked applications. So if you start with gross liability, subtract marked applications, subtract unmarked applications, and then subtract firm underwriting, you will end up with what? Net liability. That is sad purchase, amount of shares that is supposed to be purchased by the underwriter, not out of happiness. To this, if we add our firm underwriting in the total, in the normal firm underwriting, not in the gross liability ratio, we get total liability. Total liability refers to the total number of shares that the underwriter is supposed to buy. Done? And then we computed the amount so we received or paid. That's not required here. Let us answer this question. So they're basically asking us the net liability. That is the total number of, sad purchase that the shareholder is supposed to do. You get that? The underwriter is supposed to do. Company offered 250,000 shares. Ouch. 250,000 equity shares for public subscription. 70% of the public issue is underwritten by G. So underwriter G, how much is the gross liability? Gross liability is 250,000 multiplied by 70%. So if we do 250,000 multiplied by 70%, I'll get 175,000 shares. So what is it? Multiplication of these two. Done. From this, I'll subtract my shares. Shares basically that I've sold. Underwritten. Our firm underwriting was 40,000 shares. Remember, benefit is not given. No credit is given. You get that? When no credit is given, this 40,000 will not be deducted from our share completely. It will be deducted from all the shareholders together, all the underwriters together. 70% is G, no? So there will be some other person who's basically dealing with 30%. There is basically some other shareholder who's dealing with so that you will not get confused with this line. Yeah, there is some other shareholder who is basically dealing with the 30%. So basically G is able to get benefit only out of 70%. So 40,000 shares are that way. Public subscribed 130. They have not told whether it is marked or unmarked. So I'll assume it to be unmarked, or I'll assume like totally public has subscribed so much. If it is marked, they should tell no, 130,000 shares were bearing the name of G. So basically 30,000 and 40,000 shares, both are to be treated on par. Why? This 30,000 is unmarked application. Firm underwriting, benefit not given. So firm underwriting is also treated like unmarked applications only. So basically I will do how much is the shares sold? 130,000 plus 40,000 multiplied by 70%. So how much do I get? 130,000 plus 40,000 multiplied by 0.7. I basically get 119,000 shares. So these are the number of shares that these shares basically sold, or she is getting the credit for. So our target was 175,000. Out of that, 190,000 is sold. 56,000 she has not sold. So she is supposed to buy. That is our net liability. Or what we can also say, we can also call it our sad purchase. So she doesn't have an option, but she has to buy those many shares. So 56,000 shares is our answer. Sad purchase. If the question is about total liability, then we'll add 40,000 to 56 and the answer will have been 96. 96,000 is what? Total liability. But what have they asked? Net liability. You understood that this is considered as unmarked applications here. Why? Sir, is it an assumption? Can I assume it otherwise? No. If nothing is mentioned, it is unmarked. No. If it is marked, the name should be there and it should be told to us. So this with respect to question number 11. Come on, let's now go to question number 12. Question number 12 is on the side. Yeah. The entry debenture suspense to debentures. I told you, company has already created charge against all the assets of the company, so it cannot further raise debentures or it cannot further borrow money. and if it actually has to borrow the money by way of debentures, there is a long procedural aspect that it needs to do. So it will actually borrow loan, it will actually borrow money by way of loan and give debentures as collateral security. In that case, what is happening? Journal entry number 1 will be bank account debit to bank loan account. Journal entry number 2 will be debentures is given as collateral security, so added 2x% debentures account. But no money is received against it because it is only a paper, it is actually not debentures. If you fail to pay the loan, then your loan will be written off and suspense will be written off and it will become debentures. So till then it is a suspense. That suspense is specifically related to debenture suspense. So we discuss that the journal entry is bank account debit to bank loan, and second journal entry is debenture suspense to debentures, and later when it is repaid, entries will be reversed. So this is the entry that we write when the debentures are issued as collateral security. Read this question. The entry debenture suspense account debit to debentures account can be passed when, or passed or done when debentures are issued for cash? No. Other than cash? No. When you issue it for other than cash, you basically write asset to debentures, whatever the asset that you receive. On the issue of debentures as collateral security is the answer. We solved several MCQs also on this previously. So I hope you remember this with respect to question number 12. We didn't even read the other options, not necessary. Come on, let us go to question number 13. Yeah, C Limited issued 8% debentures of 65 lakh at 5% discount. So basically what they want is loss on issue of debentures. Okay, Lloyd is equal to Doyd plus PORD. What is Lloyd? Loss on issue. What is Doyd? Discount on issue. What is PORD? Premium or redemption. We have discussed this. Loss on issue of debentures is equal to discount on issue plus premium or redemption. When you are collecting, if you collect less, or when you are paying, if you pay more, both will be considered as losses. Now what is happening in this case? It is issued at 5% discount. Okay boss, so 5% discount is loss here. So discount on issue is 5%. Is there any premium or redemption? On redemption it is 10%. So when you are collecting less. When you are paying more. So basically total loss on issue is 15%. Of what? Nominal value. So what is the nominal value? 65 lakh. So loss on issue of debentures is 65 lakh multiplied by 15%. So if I do 65 lakh multiplied by 15%, my answer is 9,75,000. Yeah, conservatism principle, we need to debit loss on issue of debentures account 9,75,000 at the time of issue only. This amount will be transferred to P&L account depending upon the debenture redemption schedule. If the debentures are supposed to be redeemed in lump sum on a specific date, equal amount will be transferred to P&L account. If the debentures are redeemed in installments, some amount of debentures redeemed every year, then we find out outstanding debenture ratio at the beginning of the year, not at the end. I in fact told you why beginning and not at the end. If you take end, last year it will become 0. Yeah, that's not fair. So if the debentures are redeemed in installments, we take the outstanding debenture ratio at the beginning of the year, and in that ratio we basically segregate this 9,75,000 and then transfer it to P&L account. Done. This is with respect to question number 13. The answer is 9,75,000 to be debited because it is expense to be debited. So the answer is option C. Yes. Come on. Now let's go to question number 14. Yeah. M Limited issued 8% debentures of rupees 6 lakh on 1st of January 2019 at a discount of 10%. Oh, again this is a similar question. But read the last line, the amount of discount to be written off. In this question, we are not just stopping at identifying the amount of discount on issue or amount of loss on issue. We are further calculating as to how much should be transferred to P&L account during the year. Fine, great, let us do this. Interesting one to be precise. Yeah, question number 14. Continue reading. Loss on issue of debentures is equal to Doyd plus PORD. So there is discount on issue 10%. That is basically our loss. The debentures are redeemed in 3 equal installments of rupees 20 lakhs payable on 31st of December each year. Okay. Concentrate. The year end here is calendar year, 31st December every year. The amount of discount to be written off at the year 31st of March 2021. So they're basically asking 2021 how much will be transferred. This is little more complex than the usual because they're asking for 2021, here there is calendar year, here there is financial year. So first we'll find the amount to be transferred in each calendar year, then based on the months we'll proportionately find how much to be transferred to P&L account based on our 2021 financial year, and then we'll have the answer in our hand. Come on, concentrate. Firstly, how much is the loss on issue of debentures? That is discount on issue of debentures plus premium on redemption of debentures. In this case, there is no premium on redemption. Yeah. How much is loss on issue? 10%. So loss on issue will be 10%. Loss on issue of debentures is 60 lakh into 10%, which is loss on issue of debentures is 6. Loss on issue of debentures is 6 lakh rupees. Now this needs to be segregated based on a ratio. So concentrate here. We started in the year 19. So I'll write here 2019, 2020, 2021. Yeah. Outstanding debentures. At the beginning, at the end. At the beginning of the year, there are how many debentures? 60 lakh is the amount. I'll write 60 lakh only. Yeah, out of 60 lakh. Then what is happening? How much is redeemed every year? 20 is redeemed. So at the end of the year, there will be only 40. Next year, I'll write 60. Is that fine? I'll remove the word lakh there. So next year opening, there will be 40. End of the year, there will be 20. Because 20 will be redeemed during there. Third year opening will be 20. Closing will be 0. By the remaining balance of 20 is redeemed that year. If I take the ratio of the end of the year, the ratio will become 4:2:0. So if the ratio is 0 for 2021, amount to be transferred in the last year will become 0. So technically, I should not take the ratio of the end of the year. So I should take outstanding debentures at the beginning all by itself. You get that? So if I take the total here, it comes to how much? 60, 40, 20. So 120. Now, total amount of loss is 6 lakh. So how much is the loss for each year? Here I should do 6 lakh multiplied by 60 by 120. So how much do I get? I would get 6 multiplied by 6 by 12. So I would get 3 lakh. 3 lakh rupees. And here how much do I get? I will do 6 lakh multiplied by 4 divided by 12. So I would get 2 lakh. And here 3 will be 1 lakh. 3 lakh plus 2 lakh plus 1 lakh, 6 lakh rupees. So in 2019 calendar year, 3 lakh should be transferred. In 2020 calendar year, 2 lakh should be transferred. In 2021 calendar year, 1 lakh should be transferred. They are asking 31st of March 2021. 31st of March 2021 is 1st of April 2020 to 31st of March 2021. So this basically has two calendar years. One, 2020, 2021. 2021 may they have 3 months. Here they have 9 months. 2020 entire expenditure is 2 lakhs. So 2 lakh is for entire year. How much for 9 months? 9 by 12. 2021 may 1 lakh. So 1 lakh is for entire year. How much for 3 months? If I do it that way, I'll get 2 lakh multiplied by 9 divided by 12. So that is 1,50,000 here plus 1 lakh divided by 12 multiplied by 2. That comes to 16,660. Sorry. 1 lakh multiplied by 3 by 12. Sorry. 1 lakh multiplied by 3 divided by 12. That comes to 25,000. So the answer is 1,50,000 plus 25. That is 1,75,000. Option D should be your answer for question number 14. 1,75,000. Yeah. So important point here is the issue is made on 1st of January. Redemption is happening on 31st of December. So that is calendar year for redemption. But they are asking the amount to be transferred to P&L account in the financial year. That is 31st of March 2021 ending. So it is 2021. So some part of 2020, some part of 2021 is to be computed. 2020, April to December. That is January, February, March. 3 months eliminated out of 12, it becomes 9 months. However, those 3 months are counted in 2021, which is January, February, March, that part. So once we do this, we'll arrive at the answer of 1,75,000. That is with respect to question number 14. Yep. I hope you got a fair idea on this question number 14. Let us now quickly go to question number 15. Come on, question number 15. This question is again based on debentures, but let us see what exactly have they being asked in this. Are they asking us in this question number 15? So question number 15. Read the last line. For this, number of equity shares to be issued will be. Maybe there is conversion of debentures to equity shares. They are asking us how many equity shares to issue against these debentures. Yeah. Yes Limited had issued 80,000 8% debentures of rupees 100 each, redeemable on 31st of December 2009 at a premium of 20%. Very good. They had issued it at premium. Sorry, redeemable at premium. So basically, what is the agreed value for redemption now? So debenture holders are entitled to how much money? If you are a debenture holder in this company, you have 80,000 debentures if you hold the entire thing, basically. So, and you are eligible to receive 100 rupees towards nominal value plus 20 rupees towards premium. So the entire money that is supposed to be paid to debenture holders is 80,000 multiplied by 120. So basically supposed to pay them 96 lakh. Should pay this to them in cash. Okay. The company offered 3 options to debenture holders, out of which one is to convert their holdings into equity shares. There is an option to convert their shares into equity shares of nominal value 10 each at rupees 3.5. So issue price is 13.5. You get that? We'd have to divide this by 13.5 shares. This offer is accepted by 49,275 debenture holders only. So I'm not going to do this for 80,000. I'm going to do this for 49,275 debenture holders only. Maybe balance people will go for cash. 49,275 multiplied by 120, I would get 59,13,000 rupees. This is the amount payable to them by way of equity shares. Issue price of equity shares is 13.50. If I divide, I'll get number of equity shares. Number of equity shares will be divided by 13.5. The answer is 4,38,000. So the answer is option A. If you issue them 4,38,000 shares at 13.5, that comes to 4,38,000 multiplied by 13.5. That comes to 59,13,000. 59,13,000 is at a premium of 20. So if you divide it by 120, multiply it by 100, I'll get 49,275 shares. So basically, debentures. 49,275 debentures into 120, amount payable 59,13,000. Issue price of new shares is 13.5. Divided by 13.5, number of equity shares will come to 4,38,000. So this is the answer for question number 15. So once you're clear with this one, let me take you to question number 16. Come on, let's go to question number 16. Question number 16. Question number 16. Yes, we have it here. Okay. This is again based on debentures. Let us read the last line of the question. They basically want us, if the debenture interest is payable on 30th of September and 31st of March every year, then the amount of profit or loss on cancellation of debentures. So this is a question on own debentures. Instead of waiting till the date of redemption, if the company has excess cash, company can opt to buy its own debentures from the open market and then adjust it against the nominal value that is there on the liability side. Meaning, it will go to the market, buy its own debentures. It will become investments on the balance sheet asset side, and on the balance sheet liability side, there is what you say liability, debentures, long-term borrowings. You adjust them. Excess of liability over asset will become your profit. Meaning, liability is increasing by more than what you paid. If you would have redeemed, you're supposed to pay more. Because you bought your own debentures, you might have purchased it at a lesser price. That difference becomes your profit. And in the computation of this profit, when in consideration to own debentures, always we need to consider the ex-interest price. That is the excluding interest price. If the purchase price includes interest, such interest has to be eliminated to find cumulative of interest price. So cumulative of interest price minus interest gives you ex-interest price. In the question, if they give ex-interest price, beautiful, we can take it straight away. In the question, if they give ex-interest price, would have to, in the question, if they give ex-interest, easy. If in the question they give cumulative price, the ex price, that will be considered in our answer. Come on, let us get going. G Limited has 8,12% debentures of 100 each. Okay. So 2018-19, the company purchasing its own debentures from open market. We know this. When we read last time, we understood something of this, what is happening. So there is two purchases. First one is on 1st of August. Okay, 2018. What is happening on 1st of August 2018? 15,000 debentures. Very good. At what rate? At 95.50 ex-interest price. So should it be any adjustment? Not necessary. So how much is the price that is paid? 15,000 debentures multiplied by 95.5. I will get 14,32,500. Very easy. Done. Next, go to 1st of January 2019. How many debentures are purchased? 25,000 debentures. At what price? 101.50 cumulative of interest price. Here I am supposed to eliminate the interest component to find my ex-interest price. Come on, let us do this. Firstly, how much is the cumulative interest price here? 25,000 into 101.5. That gives me 25,37,500. So meaning I paid some interest also to the seller. Now the interest component. Interest should always be computed on the nominal value. What is the nominal value? 25,000 debentures into rupees 100 each. 100 is a nominal value. It's been given. So interest should be calculated on the nominal value at all times. What is the percentage? 12%. What is the period for which interest should be calculated? That period for which it should be calculated is the last date of interest to the date of transaction. I repeat, in order to compute ex-interest price, when we are about to deduct interest from cumulative of interest price, the interest to be deducted here is the interest computed for the period starting from the last date of interest till the date of transaction. Now before 1st of January, when was the last time interest was paid? Interest dates are 30th of September, 31st of March. So before 1st of September in 2018, the earliest date is 30th of September. So they would have last paid interest on 30th of September. We need to compute from 30th of September to 1st of January. 30th of September, September month over, October, November, December, 3 months. I do it for 3 months. So this is from September to December. You get that? I can write, if you want I can write it more in detail, but I think this is sufficient. So if I do 25,000 multiplied by 100 multiplied by 12% multiplied by 3 divided by 12, I end up getting interest of 75,000 rupees. Okay, I'll write it here. This is 25,37,500. If I deduct it, how much will be my ex-interest price? Ex-interest price comes down to 25,37,500 minus 75,000. That gives me 24,62,500. So total, now come, let's do the totaling part. So totally 15,000 here, 15,000 debentures here, 25,000 debentures here, 14,32,500 here, 24,62,500 here. Both are my ex-interest prices. So for 40,000 debentures, I paid how much? 24,62,500 plus 14,32,500. So I paid 38,95,000. Yeah, what is this price that I have paid? Whereas, what is my nominal value? Purchase price. What is my nominal value? Each debenture is of rupees 100. So 40,000 debentures into 100 rupees each. That comes to 40 lakh. So guys, 38,95,000 is the purchase price. 40 lakh is the nominal value. The difference is the amount that I paid less. So if I would have redeemed or waited till redemption, I would have paid 40 lakh rupees. Because I went for own debentures, I paid only 38,95,000. If you subtract 38,95,000 from 40 lakh, you get 1,05,000 that you paid less. This is the profit on cancellation. Meaning your liability will decrease by 40 lakh and your asset will decrease by 38,95,000 only. So your asset is decreasing less and your liability is decreasing more. Difference is your profit. So the answer should be 1,05,000 profit. That is option D. Yes. So this is with respect to question number 16. If you want to take a screenshot or if you want to just note it down, I'll leave you with this for a second. And then come on quickly, let's go to question number 17. Yep, come on, let's go to question number 17. Profit on cancellation of debentures. Where do you transfer profit on cancellation of debentures? It is a profit which is capital in nature. It will be transferred to capital reserve. You cannot transfer it to P&L account because it is not the item which belongs to current year. It is not in the normal course and it is not, it is not in the normal course of the operations. It will lead to inflation of current year profit. So it should be definitely transferred to capital reserve. Yes. So this is with respect to question number 17. Come on. Let us now go to question number 18. Question number 18. Yeah. Every buyback shall be completed. Okay. Once a buyback has been basically ordered and then the special resolution is passed against the same, or if the special resolution not required, then the board resolution is passed, then such a particular buyback should be completed within the span of 12 months or over 1 year. So if it is not done, then the process should be redone again. Again, you need to pass board resolution. Again, you need to go for a special resolution or whatever is required for the purpose of compliance. Come on. Let us go to question number 19 now. Question number 19. What does it talk about? It talks about a machinery. Come on. What will be the cost of this machinery purchased on 1st of April 2014? So they are asking what is the cost when it was purchased on 1st of April 14. So what is the present date? Written down value of the machinery on 31st of March 2019. Okay. We are right now in which year? March 2019. End of 2019. And they want us to find it as on 1st of April 14. Okay. So how many years should we go back in time? So 2014-15, 2015-16, 2016-17 and 2017-18, 2018-19. 1, 2, 3, 4, 5. So I should basically go back by 5 years. Go back by 5 years. Okay. The company's value as on that date is 6,65,558. So today it is 6,65,558. What was the value of the machinery 5 years ago? Is the question. Okay. Rate of depreciation is return on value method 15%. Meaning, see, if it is 100 at the beginning, at the beginning of the year, if it is 100, depreciation will become 15. And at the end it becomes 85. Next year it is 85. Again there is some depreciation. I mean, say you say 85 into 15%, you will arrive at 12.75. If you subtract this from 85, you will get 72.25, something of that sort. So that way it is not 100. Some value is there, and at the end of 5 years it is basically 6,65,558. So 6,65,558 is 85%. So how much is 100%? If you do divided by 85%, you will get fourth year's value. If you again divide by 85%, you will get third year. Again divide by 85, you will get second year. Again divide by 85, you will get first year. So basically, 6,65,558 should be divided by 85% 5 times. If you divide by 85% 5 times, you will get the original cost of that particular asset. Come on, let us do this. 6,65,558 divided by 0.85. 7,83,000. This is the value as at the end of year 4. I'll again divide it by 85% or 0.85. So 2 times done. Again divided by 85%. 3 times done. Again divided by 85%. 4 times done. Again divided by 85%. 5 times done. So I'll get the value of 15 lakh. You might get some decimal values. Point some 10 and then like 7041. So the answer is basically 15 lakh rupees. If you want, you can do verification. You can take 15 lakh, subtract 15% once. You will get 12 lakh 25,000. 1 year depreciation done. Minus 15% once again. 10 lakh 87,000, 83,750. Second year depreciation done. Again do minus 15%. 9 lakh 21,187. Again do minus 15%. You will get 7 lakh 83. Again do minus 15%. Fifth year when you charge the depreciation, the value will come to 6 lakh 65,557. That is the value after fifth year. 6,65,558 rounded off. Okay. So the answer is option A for question number 19. So we are going back in time basically to find the original cost of that particular asset. Come on, let us go to question number 20. Or 20 is below only. G Limited, there is one whole-time director. Oh, basically this question is on managerial remuneration. So there is one whole-time director. When there is one whole-time director, it doesn't. If there is one whole-time director, how much percentage of remuneration? 5%. If there is two whole-time directors, 10%. If there are three whole-time directors, 15%? No. One whole-time director, 5%. More than one whole-time director, 10% only. If there is one managing director and one whole-time director, still 10%. If there are one managing director and two whole-time directors, still 10%. You get that? So full-time directors, part-time directors. Full-time directors, if they are there, only 5% if they are one in number. If they are more than one in number, we give 10%. And there are three part-time directors. So it doesn't matter about how many part-time directors are there. The moment they are part-time directors, they are either eligible to 3% or 1%. If there is no whole-time director, they get 3%. If there is whole-time director, they get 1%. So basically, these other directors will get 1%. The maximum rate of remuneration payable to all the directors. All the directors together means whole-time directors and part-time directors together. How much are they eligible to? 6%. How? 5% towards whole-time director, 1% towards three part-time directors. So the total remuneration or the maximum remuneration that can be paid is 6%. Sir, when will the answer be 11%? When there is more than one whole-time director in the organization, this 5 will become 10, this will remain 1, and the answer will be 11. Done? So however, remember, this remuneration is only when there is adequate profits. If there are no adequate profits, then you go by effective capital. If you can recall, 60, and then 72, 84, 120, and then greater than 120 lakhs plus 0.01% of effective capital. Yeah, come on. Let us go to the next part of the question. 28th one done. Let's go to 21st one. 21st one is with regard to that inadequate profits. See, when there is no adequate profits, then how do we give the remuneration? It is based on the effective capital of the company. If the effective capital is between 100, there are slabs. I want you to go back and then revise that part once. In fact, there is a separate video on this managerial remuneration, a 10-minute video. You can do that to completely revise our entire managerial remuneration. So a company has 100 crore, more than 100 crore, but less than 250 crores. Under the old provisions, it was 60 lakhs. Under the new provisions, it is 120 lakh rupees as the managerial remuneration for all the managerial person together for an entire period. You get that? That's it. Then the answer will be 120 lakhs. 120 lakhs. However, there is a provision to double this 120 lakhs if they fulfill with certain conditions and pass a special resolution against the same. 120 lakhs can be doubled to 240 lakhs. Yeah. For now, if it is between 100 and 250 under the new provision, in the case of inadequate profits based on the effective capital, maximum remuneration is 120 lakhs for all the managerial persons together per annum, not for each month. Done. So that is with respect to question number 21. Let us now go to question number 22. Every company having dash during turnover of how much during the immediately preceding financial year is supposed to comply with Corporate Social Responsibility Committee. So this is given under section 135 of the Act. Yeah, I had told you previously, you guys better prepare a chart. It's covered as a part of the syllabus, but you guys have to prepare one chart which talks about section 135, what is the limit, section 138, what is the limit, section 148, section 177, section 178, women director and independent director. Yeah, all those things I want you to prepare one chart. Here you write the section, here you write PUC, turnover, net worth, and then outstanding loans, outstanding borrowings, net profit. You write everything. So one chart will give you entire data and you can look into that chart whenever you basically want any information regarding any provisions of that. Yeah, going ahead, every company having turnover of how much? If the turnover basically exceeds 1000 crores, if the basically turnover exceeds 1000 crores, then you're supposed to constitute one CSR committee. So this is with respect to section 135, question number 22. Let us now go to question number 23. Yeah, okay, accounting standard 17, segment reporting. I told you segment can be decided based on the geographical location as to where exactly it is, or based on the product or the service it provides. Done. So they're asking which of them is not a type. Yeah, it's a negative term. Which is not a segment should be marked as the answer now. Geographical segment, yes, a part can be considered as a segment based on its geographical location. Business segment, yes, based on its business line. Based on the industry, nah, this is something that we have never come across. There's nothing called as industrial segment. There is something called as reportable segment, that is based on our MART, if you can recall, managerial discretion, based on the segment assets, based on the segment profits, that is result, and based on the turnover, 10%. And we also did few questions on profit. Whenever there is losses, profit making segment, loss making segments to be seen separately. Yeah, we didn't just do this in accounting set chapter, it came as a part in some other chapter also, if you can remember. Management reporting chapter also, there is a question on this. Done. Let's go to question number 24. Equity shareholder of a company who does not have the voting control of the company by virtue of his or her below 50% ownership. If you hold below 50% ownership, then what are you called as? A minority shareholder. So this is with respect to our question number 24. So you hold more than below 50%, you are minority shareholder, not a small shareholder. Small shareholder director is something else only. You get that? Yes. Let's go to question number 25. What does it talk about? H Limited is a holding company of subsidiary limited. H Limited. So basically this is a question on consolidation. Great. Our favorite chapter. During the year 2018, bills receivable amounted to rupees 4 lakh. Okay. Out of bills receivable of 5 lakh received from H Limited. So let us break this down in bits and pieces. Let us not read the entire question and make ourselves confused about this. So let's read little and then write little. So there is H, there is S. So H Limited has bills receivable, H Limited has bills payable. So how much is H Limited's bills receivable? 5 lakh. Out of this bills receivable of 5 lakh, from S it is 4 lakh. So others say how much? 1 lakh. I will write 5 here, 5 lakh. I will write yes, 4 lakh, others 1 lakh. So S Limited has bills payable. Yeah, how much does it have? I don't know how much about others, but from H it has 4 lakh. Done. Let's continue. We wrote the entire data. What we read now. Let's continue. What discounted by H Limited? Okay, these were discounted by H Limited. So basically, H Limited, does it have this bills with it now? So it doesn't have these bills with it now. 4 lakh is already discounted. So H Limited basically doesn't have these debentures which were received by H, isn't it? Out of bills receivable amounted to 4 lakh. Out of the bills received of 5 lakh from H Limited. Oh, sorry, entire 5 lakh is from. Sorry. So H Limited say there is 5 lakh. Let us read this once again. Bills receivable amounted to 4 lakh. 4 lakh out of 5 lakh is be discounted. So from S Limited there is 5 lakh. Total we don't know. So it has 5 lakh from S Limited. Out of this 5 lakh, 4 lakh is discounted. How much is still holding? 1 lakh still the H Limited has it with it. So with respect to 1 lakh, it is our mutual indebtedness. With respect to 4 lakh, as it is discounted, it is not being held. So what will happen here? So S Limited has how much debentures now? Sorry, how much bills receivable now? So bills payable, it has 5 lakh towards H Limited. Okay, let's continue reading. Were discounted by H Limited, full stop. And H Limited had endorsed it to its creditors. Oh, so what has happened? H Limited, this is with respect to some other thing only. So here there is 1 lakh. Here there is 1 lakh. So mutual indebtedness is only with respect to 1 lakh here. Okay, next. S Limited had endorsed its creditors all the bills receivable from H Limited 3 lakh. So S Limited had bills receivables of 3 lakh from H Limited. So H Limited had bills payable of 3 lakh from H Limited. But what has H done? Endorsed. It has endorsed entire 3 lakh to its creditor. It cannot endorse it bills payable. It has endorsed it bills receivable from H Limited. So this entire 3 lakh is not mutual indebtedness here. So nothing of which is held by H is common with S. So there is no mutual indebtedness here. There is no mutual indebtedness with respect to this part. With respect to this part, there is 1 lakh mutual indebtedness. So let's continue reading. At the end of there, the amount of mutual debtors will be, what is the answer? It is for rupees 1 lakh. Is it there? Yeah, option D, 1 lakh is the answer. So I'll repeat. H has bills receivable of 5 lakh from S, out of which 4 lakh is discounted. So how much does the H still hold? 1 lakh. S holds the entire thing. So 1 lakh is there in H also, 5 lakh is there with S. But commonly what is there? 1 lakh. So that 1 lakh is mutual indebtedness. Now what is happening with respect to S Limited? S Limited holds bills receivable of 3 lakh from H. But entire 3 lakh is endorsed. So S holds 0. So though H hold, nothing is held in common. So it is not mutual indebtedness at all. So the mutual indebtedness in this question in total is 1 lakh, which is bills receivable to H and bills payable to S. It will be subtracted from total of bills receivable as well as bills payable in consolidated financial statements. So the answer to question number 25 is 1 lakh rupees. Yes, come on. Let us now go to question number 26. Question number 26. What does question number 26 talk about? On 1st of April 2016, H Limited purchased 16 lakh shares out of 20 lakh. Okay, 16 lakh out of 20 lakh. How much is the percentage of holding? I'll do 16 divided by 20. So 80%. So basically, H Limited holds 80% of the shares of S Limited. Equity shares of S Limited. Following information is provided as on 31st of March 2019. What do they want? Is again consolidation question. Minority interest is what they're asking. Okay, how much is minority? If you basically see, 80% is controlling interest, 20% is non-controlling interest or minority interest. The term controlling interest, non-controlling interest is in Ind AS, whereas in accounting standards, the term is only minority interest and holding. We have referred to this in the consolidation chapter. Come on. Now, minority as share in share capital. How much is share capital of the company? 20 lakh. I'll multiply it by 20%. And there is general reserve, 45 lakh. Out of this also, they get share of 20%. There is statement of profit or loss. How much? 32 lakh. In this also, minority will get 20%. Yeah, and on 1st of April, machinery of S Limited revalued by H Limited 25% above. So whenever the asset value is increasing, correct, reserve also will increase. So revaluation reserve is profit. It's a positive item. How much? 25% of book value. If you multiply 25% on 1 lakh, 12 lakh 50,000. 12 lakh 50,000 multiplied by 25%. 3.125 lakh. Out of that also 20% will belong to minority. That's it. Yeah. How much will be minority interest? I'll find it. Instead of multiplying each of them, I'll do 20 lakh plus 45 lakh plus 32 lakh plus 3.125 lakh. Total will come to 100.125 lakhs. I'll multiply this by 20%. I'll get 20. What do we get? Basically, we get. Is there any part of it? Anything else? 20.025. Is that the answer? No. What did we do wrong here? Equity share capital is. Oh God, it's not 20 lakh, it is 200 lakh. Why? It is 2 crore. So 200 plus 45 plus 32 plus 3.125 multiplied by 20%. So we get 56 lakh 2,500. This is our minority interest. Yes, in our first set of classes, the last day was our consolidation. Last 2 days was our consolidation. Yeah, 56 lakh 25,000 is the answer. I hope you still remember and like this chapter of consolidation. So the answer to question number 26 is 56 lakh 25,000, and this is our working. Yeah, you can multiply it individually, but that will take a lot of time in the exam. So add everything and then multiply 20% at once, because ultimately it's 20%. No, if you want, you can write share capital 2 arrow marks, reserves 2 arrow marks, everything you put 2 arrow marks. Find the minority, all the minorities you put 1 arrow mark and then total it. You will get the same thing. But I found this to be very easier to write. Come on, let us go to question number 27. Question number 27. Question number 27, again it's on consolidation. How do you know, sir? They've told holding limited 75%. So they've told the percentage of holding by themselves. So it will become easier for us. So holding of S Limited was 75% in S Limited. Other information is here. So what do they want? They basically want cost of control. Okay guys, come on, let's start finding cost of control. You remember how to find cost of control? Yeah, share capital is 150 lakh. So what is the nominal value of the shares held? 150 lakh multiplied by 75%. So how much is 150 multiplied by 75%? That is 112.5 lakh. Everything is in lakhs. So this nominal value or cost of investments. Then we'll have book value. Book value is the price that is the company has paid to buy it. They've told estimated cost of investments is 160 lakhs, 162 lakhs. So have we paid extra or have we paid less? So nominal value is 112.5. We paid 162. We paid excess. How much have we paid? That excess that we paid is basically goodwill. So 162 minus 112.5. That comes to 49.5. Sir, shall I take 49,500 here? 14.5 lakhs. No, wait. There are reserves on surplus. We need to segregate reserves on surplus as pre and post. Pre-reserves will become capital reserves. Total of capital reserves should be adjusted here. Yeah, we have to do that. So let us see further. Have they told anything about what was the reserves on the date of acquisition? No. So we'll assume that the acquisition has happened today only and this is the value of the reserves. So let us take it. So 150 is share capital. So total reserves is how much? 25, 35 and capital reserve of 10. So 25, 35, 10 belongs to both. Now I can individually do it. 25 made 2 arrow marks, 35 made 2 arrow marks, 10 made 2 arrow marks, capital reserve, revenue reserve, and then that capital again holding minority. I can do that. But instead I can do it in total now. So how much is total? 25 plus 35 plus 10. That comes to 70. So total is 70. Now 70 if I categorize it into holding and minority, how much will holding get? 75%. So how much is 75% of 70? 70 into 75%. That gives me 52.50. So 52.50 is capital reserve. I'll write here capital reserve 52.5 lakh. Now goodwill is more or capital reserve is more? Capital reserve is more. I'll write capital reserve. So like signs, plus minus, minus, and I should do subtraction. 52.5 minus 49.5 gives me 3. So the answer is capital reserve of 3 lakhs. That's the answer for question number 27. So let's check the answer. Capital reserve of 3 lakhs. Option C is the answer for question number 27. So this is with respect to question number 27. Once you're done, let's go to question number 28. Come on. Let us now go to question number 28. What is the main purpose of consolidation? Compliance of Accounting Standard 21? Yes, that's the answer. To comply with legal provision of Companies Act 2013? Yes, that is also the part, because section 129 of Companies Act, in the definition of financial instruments, it includes consolidation, and it is mandatory to do consolidation whenever you have a subsidiary company. To reflect the true and fair view. I told you, you are overshowing your assets or you have invested in yourself, so you need to subtract the assets as well as liabilities. When we did our first example, if you remember, I cannot just add everything and then write, because it is just the total of the balance sheet is increased. So in order to arrive at the right value, we have to do consolidation rightly by adjusting the items. So option 3 is also the answer. So the answer is option D, all of the above. So the reason why we prepare consolidation is compliance of accounting standard, compliance of provisions of the act, and also to show the true and fair view of the financial statements of the entire group as a whole. Come on, let's now go to question number 29. Question number 29 talks about company's audit report order. We discussed in the yesterday's class. So according to section 143 subsection 11, central government has the power to specify certain items which the auditor should include in his report. So using such powers, MCA in consultation with NFRA has increased CARO. CARO 2016, CARO 2020. We discussed the differences also, what are the new clauses that's come up, and we've done a separate video on CARO 2020 in comparison with CARO 2016. You can have a look at it if you want to deal with this in detail. So Ministry of Corporate Affairs in consultation with NFRA basically issues CARO, and for the exam in month of June, which is now postponed to July, what we need to read is CARO 2016. For the exams after that, it's CARO 2020. So the answer for question number 29 is basically MCA, not the movie name, it's the Ministry of Corporate Affairs. CARO 2016 is not applicable to, we discussed, no, it is not applicable to banking companies, it is not applicable to insurance companies, it is not applicable to Section 8 companies, Section 8 companies, CSR, CA, CSR, we discussed what is Section 8 also in detail. It is not applicable to one-person company and small companies definition is again discussed, and then we also told that it is not applicable to private companies whose paid up capital and borrowings is less than 1 crore individually, and their turnover is lesser than 10 crore rupees. Definition of paid up capital, definition of borrowing, everything is discussed in detail in CARO part 1 video, wherein we discuss the applicability of CARO. So for these companies, it is not applicable. So it is not applicable to insurance companies, correct. It is not applicable to charitable purpose, yes. Section 8 company, one-person company, not applicable. It is not applicable to all of the above. In addition to this, it is not applicable to banking company, small company, as well as private company subjected to those limits. Come on. So that's with respect to question number 30. Let us now do question number 31. So as per section 149 subsection 1, section 149 talks about company to have directors. So section 149 subsection 1 of Companies Act talks about paid up capital requirement for non-listed company to have women director. If it is a listed company, it is supposed to have women director. If it is a non-listed company, it has two conditions. One is based on the paid up capital, second one is based on the turnover. The condition based on the paid up capital is 100 crore. If the company's paid up capital exceeds 100 crore, then it is supposed to have women director. Or if the company's turnover exceeds 300 crores, again it is supposed to have a woman director. So PUC greater than 100 crore, turnover greater than 300 crore. If it is unlisted, mandatory remain director. If it is listed, don't look at these conditions, mandatory remain director. Done. So that is with respect to question number 31. Let us now quickly go to question number 32. This is our corporate financial reporting chapter that we did in the last from corporate accounting part. Yeah. So what does it say? The concept of gross value added is given as how? Gross value added, I told you there are two things. One is value added and then value applied. How do we compute the value added? We take our sales and then subtract the cost of goods bought out and other things. We basically arrive at the value added, and this should be apportioned to shareholders, to employees, to government, to management, to people who lend us money and all these things. If you would have read that small paragraph of theory that is given in our material, you would have understood this part. So let's see what exactly is the concept. So distributed to employees, salary, wages, government, tax entities, correct. Financials, correct. Option A seems to be correct. Let's see option B. Government in the form of tax entities, financiers, shareholders. This doesn't have employees. So option A has better. Option A has more things than option B. Option A is correct, but not completely correct. Option B is correct, but A is more better because A has employees and B doesn't have employees. Yes? Come on, let's go to option C. Option C has employees, government, wages, taxes and interest. Yes. This is also similar to A. Whereas option D looks like it says employees, it says salaries and wages, government, taxes and duties, interest, form of dividend and remaining balance retained earnings. Retained earnings is not covered in other options. That is also part of it. Part of our value applied. So option D is the answer because it refers to value applied to shareholders, lenders of money, government, financiers as well as retained earnings. If money value is not applied for any other purpose, it will be retained with the organizations and then carried forward to further periods. So for the gross value added question, answer which has more details in it, like almost every aspect in it is question or say option number D, and that is our answer. Let us now go to question number 33. The term calls in arrears is shown in the company's balance sheet where calls in arrears refers to that bad shareholder who didn't pay us money, is still supposed to pay us money. With respect to that shareholder, when we are supposed to collect the money, it is our asset, but it should not be shown in the asset side because what do we do on the liability side of the balance sheet is we write called up capital. From that called up capital, to the extent we have not received, we subtract. That's how we arrive at paid up capital. You get that? So called up capital minus calls in arrears will basically give us paid up capital. So what do we do? It should be deducted from the called up capital. Done? So this is what we do with respect to question number 33. That is calls in arrears has to be deducted from the called up capital. Option C is the answer for question number 33. Come on. Let us now go to question number 34. When we finish 33rd one, what we can take a note is we finished 1/3 of the questions. Have a look at the amount of time that you've taken and 1/3 of the questions. If you feel very devastated, try and say yourself again that you are here, you are learning the answers and I am teaching the answers. In the exam, you will not be learning it, you will only be solving it, and you can do it quite a lot quick. And here I explained a lot of other things associated with the particular provision rather than just telling the answer, but you will not be doing that in the exam. However, in the later part of the paper, you get a lot of MCQ questions which are based on completely company law and theory ones, wherein there is not much of computation required. So there your answers will run faster and definitely doable paper in the span of 3 hours. You can finish off the paper in 2 hours, come out and then have a juice. Yeah, definitely you will finish it in less than 3 times. So time will not be a constraint in this paper. Yes, come on, let's go to question number 34th one. 34th one talks about at the time of forfeiture of the shares, share capital account. What do we do with share capital? It will be debited to the amount paid up. You get this? So debited to the extent of amount paid up is the answer. Yes or no? Sorry, share capital account called up. If you remember a super duper working note, share capital account should be debited to the extent of called up. Share forfeiture account should be credited to the extent of paid up. Calls in arrears to the extent of unpaid. So if the question is about share capital account, it is to the extent called up. Here it is forfeited. No. Oh, sorry. What do we do? At the time of forfeiture of share capital account will be debited for sure. So all the options are debited. Where do we have called up is the point. Option B. Debited with the called up value of shares forfeited. That's the answer. Paid up will go to where? Share forfeiture account. Face value will go nowhere. Issue price, this is also not to be considered. So the answer is option B for 34th one. It is with respect to amount called up. Come on. Let us now go to question number 35. The loss or discount on reissue of forfeited shares. It should be adjusted against the money that is previously collected. So that money previously collected is amount paid up. Amount paid up is transferred to share forfeiture account. And on reissue, discount on reissue will be adjusted against the share forfeiture. Balance will be our profit. So loss or discount on reissue should be adjusted against the balance in share forfeiture account, and it cannot exceed the balance in share forfeiture. That's the concept of minimum reissue price that we arrived at. So it should be equal but not exceed. Okay, basically it should not exceed the forfeited amount. So 35th one, the answer should be B. It should not exceed the forfeited amount. Done? That's the concept of minimum reissue price. Let's go to question number 36. Question number 36. When the forfeited shares were originally issued at premium, maximum permissible discount on reissue will be. What is the maximum permissible discount on reissue of those particular shares? Amount which is not received from the previous shareholder. You get that? So amount which is unpaid. So what would that be? Amount of premium at the time of original issue? No. Amount credited to forfeiture account? No, because with respect to 36 one, amount credited to forfeiture. No, sorry, maximum permissible discount is limited to. We discussed this, no? 35th one is same. 35th one talks not to exceed forfeiture amount, so that is the maximum discount that can be given. And then 36th one talks about what is the maximum discount, so it is amount credited in forfeiture account. So if you know one concept, you could have answered 2 questions and you would have got 2 marks here. Yeah, that is with respect to question number 36. Come on, let us now go to 37th one. 37th one, Z limited. Okay, this is again forfeiture question. Yeah, let us do this one. So let us read the last line. At the time of forfeiture, equity shares capital account will be, equity share capital account should be debited with what amount called up. Equity share capital account should be debited with amount called up. How much is the amount called up? Let us see this question number 37. What does it say? It has the 5,000 equity shares of rupees 10 each at 10% premium, which is payable on allotment. Company received application money at rupees 3 on share, and on allotment. Sorry, company received application money at rupees 3 per share, and allotment money received only on 4,500 shares. Okay, allotment money received only on 4,500 shares. So 500 shares you didn't receive the money. So 500 shares only we basically do the calculation. 500 shares into application money. How much is the application money? 3 rupees. And how much is the called up capital? Is application plus allotment. 3 rupees on application, 3 rupees on allotment. So 3 plus 3 is 6. We have not gone for the further call. So the answer should be 3 plus 3 is 6. 6 into 500, that is 3,000. 3,000 should be the amount which should be basically debited to share capital account. So the correct answer is option C, debited to share capital account. 3,000 should be debited to share capital account. So this is our question number 37. Come on, let us now go to question number 38. Shall we go to question number 38? Yeah, this is the one. So there is a little bit of mistake in this question because the question doesn't really have sufficient information regarding beta in this question. This is a question on weighted average cost of capital. In order to find weighted average cost of capital, we basically use that formula of risk-free return plus beta into rate at market rate minus risk return. Basically use that formula, no? RF plus beta into R minus RF. So here the beta is not given to us in the question. So in the absence of beta, we can definitely not be solving the question because beta is the sensitivity index which basically tells what is the extent of impact on the share of this particular company based on the index change. If the index changes, if beta is 1, it basically signifies that the amount of change will be equal. If the beta is 2, if the market goes by 1 point, this company shares will go up by 2 points. If the market goes down by 1 point, this particular share goes down by 2 points. So that's the sensitivity index. So that has to be given to us because we don't really have sufficient information to compute beta also. So this is a question with incomplete information, and let me tell you, question number 38 is technically incomplete in our paper, and there should have been a grace mark regarding question number 38. Yeah, because it doesn't have complete information. Done. And if I assume beta to be 1, then firstly the basis is not correct. Even if I do, then I might not get the answer one among these options again, because again the tax rate is not given, and they have not mentioned whether the bank overdraft is used for long-term purpose or short-term purpose. So it comes up with a lot of other assumptions, like I'll assume beta to be 1, I'll assume bank overdraft 40 lakhs is short-term, or if I assume long-term, it opens a lot of arena for options, and we cannot do it under multiple options to check what if more than one option is covered. Yeah, so basically 38th one I personally regard to be it an an option which is question which is like incomplete, or there is an error with this, or prima facie if you can see here long-term debit is given, it should have been long-term debt. Very small error, not to be the worry is not about that. The worry is really here is basically no information regarding bank overdraft, whether it is what type, and the second one is beta being absent in the question. Start with question number 39. 39 talks about the difference between the capital total market value and capital invested is market value added. Yeah, go back and then please read that one paragraph of explanation given on market value added, and you will end up understanding the same. The question itself says the market and the capital invested difference is definitely market value added. Come on, let's go to question number 40. Question number 40 talks about Pooja Limited had some investments. Okay, what do we do about it? The cash inflow and outflow from investment activities will be. So they're basically asking us to compute the cash flow from investing activities. This is a question on cash flow statement chapter. So they've given investments. We'll open one ledger. We did a lot of small capsule questions on assets, purchase, sale, similar to that. So if I open a ledger for investments, investments is my asset. I would have to write the opening balance on the debit side and the closing balance on the credit side. I'll write 2 brought down. How much is my opening balance? 68 lakh rupees as on 31st of March 18, 81 lakh as on 31st of March 19. So the 68 lakh will become my opening, this 81 lakh will become my closing. So I'll write 68 lakh, everything is in lakhs here, by carried down is 81 lakh, done. During the year, company had sold 30% of its original investments. When the investments are sold, you receive cash, it's a cash inflow. Cash account should be debited and investments account should be credited. Why? Cash is an asset increasing debit, investments is an asset decreasing credit. So the journal entry will be cash to investments. In investments, I'll write by cash. So how much of it is sold? 68 lakh into 30%. 30% of your original holding of 68 lakh. Done. That is the cost of the investment sold. If it is sold at loss, I would have to deduct it from my 68 into 30. 30%, whatever the answer I get. If it is profit, I would have to add it to this cost price. They have told it is sold at a profit of 9 lakh 60, so I'll add plus 9.6. So how much is my selling price? 68 into 30% gives me cost of 20.4 lakh plus 9.6 basically gives me 30 lakh. Whereas the investments has gone out only to the extent of 68 into 30%. That 9.6 lakh of profit, whatever is received in excess, should go to my P&L account credit side. If it should come on the credit of my P&L, it should come on the debit of my investments. I'll write in the debit of my investments as P and L, profit of 9.6. And that's it. No other information is available. So, if you had 68 and you had profit of 9.6, you cannot have closing of 81 after selling 30. So, the difference is purchase. Yeah, there is nothing like abracadabra, gilly and investments were born, or the eggs were hatched and then investments happened. Yeah, so this is something called as purchase. Purchase, you need to pay cash, so it is cash outflow. So come on, let us find the balancing figure. I'll do 81 plus 30, total of credit, minus 68 on debit, minus 9.6 on debit. So I'll get 33.4. You get that? So there is outflow because of purchase, that is 33.4. There is inflow because of sale, that is 30. So 33.4 and 30 should be the options. So we have two options here. Option B talks about 33.4, option D talks about 33.4 and 30 both. So which among these is correct? Can't be both, no? How is it? Let's read this part of the question once again as to what exactly do they want. They're asking cash inflow first and cash outflow next. So what is inflow? 30. So 30 first. So should take 30 first and then take 33.4. So the option which has 30 first and then 33.4 next is the answer. So the option D is the answer. A lot of us might not even read option D. We might just pounce on option B and then answer it. Yeah. So you need to be a little careful here because it's becoming a little tricky at this stage. Yeah. Come on. Let us go to 41st question. 41st question. Again, it's based on cash flow because they're asking cash outflow, cash inflow and other things. Come on. Let us start doing question number 41. During the year 2018-19, a company redeemed 10% of its debentures of rupees 8 lakhs at a premium of 10%. So how much is the redemption that's happening? You're paying 8 lakh plus 10%. That is 8.8 lakh. Yep. This is our outflow. This is outflow because you are paying cash. And sometime a fresh issue was also made. Okay, this is redemption. Now tell me what is the fresh issue or how much is the fresh issue? Fresh issue was made of new 10% debentures at 7,50,000, 7.5 lakh at a premium of 25%. So if we do 7.5 plus 25% premium, it comes to 9.375 lakh. And this is inflow. And they're asking net flow. When they're asking net flow, we'll find the net of it. Is inflow more or net outflow more? Inflow is more. So the answer should be inflow. If there is only one option with inflow, then that would have become the answer. But there are like two options with inflow. Come on, let's go to the difference now. 9.375 minus 8.8. That gives us 0.575. 0.575 lakh. That is nothing but 57,500 inflow as our answer. 57,500 of inflow is our answer. So the answer is inflow 57,500. Option C is the answer for question number 41. Come on, let us now go to question number 42. Yep, this is for 41st one, 57,500, option C. Let's go to 42nd question. Yeah, in the case of a financial enterprise, important financial enterprise, if it is not a financial enterprise, the answer would have been little different. Yeah, cash flow arises from interest paid. See, if you're not dealing with financing, if you're a manufacturing entity, interest paid will be financing activity, interest received will be investing activity. If you are dealing with a financial enterprise, it is their normal course of operations to lend and borrow money. So interest paid and interest received both will become operating activity. I'll tell you, if the word financial enterprise was not there, if it was a manufacturing entity, then with respect to question number 42, the answer would have been different. Yeah, if the interest is paid, financing; if the interest is received, investing. Because it is financial enterprise, interest paid or interest received, in either of the cases, it will definitely be operating activity. This is with respect to question number 42. Come on, let us now go to question number 43. 43 is a balance of tax on provision. You remember we discussed this concept of idli. Whatever the batter that is made today, it will be used to make idli tomorrow. If you want to make idli today, then the batter should have been made yesterday. So last year's provision is for current year tax. I mean to say, you make the provision during the current year but pay the tax in the subsequent period. So opening balance is the provision that was created in the last year, for the last year, but it will be paid during this year. For the current year, provision will be created during the current year, but the payment will be made in the next year. You understood that? Provision is a liability, so I basically will open a provision for tax ledger with opening balance on the credit side, closing balance on the debit side. So they've told balance of provision for tax is on 1st of April 18. That is opening. By brought down. How much of it is opening? 13,72,000. 2 carried down. How much is closing? 14,55,000. I can write it better and little bigger. By brought down is 13,72,000. To carry down is 14,55,000. During the year, 12,05,000 were paid towards income tax. When 12,05,000 is paid, what is the journal entry? Cash is going out. So cash account credit. Provision for tax is reducing. Provision for tax debit. So I'll write here to cash. How much was paid? 12,05,000. So how much was the provision made during the year? P&L account, and this is the balancing figure. Yeah, you are supposed to pay 13,72,000. Out of that, when you pay 12,05,000, what you should have been paid, what is balance to be paid, should have been 1,67,000, but the total payable is 14,55,000. So if you subtract 14,55,000 further, you get 12,88,000. Yeah, 12,88,000. This is the amount of provision that is created during the year. So that's our provision for tax account. The answer is option B, 12,88,000. I hope you got this point. So this is your answer with respect to question number 43. Let us now go to question number 44. 44 is on the next page. Question number 44. Original plant original costing 1,35,500, accumulated depreciation of 70,800 was sold at a profit of 5,900 during the year. Okay, so a very simple question. Let us start doing it. Original cost 1,35,500, accumulated depreciation is 72,800. If I do this, I'll get WDV or book value. How much is book value? 1,35,500 minus 72,800. I'll end up with value 62,700 rupees. Yeah. This was sold at a profit of 5,900. So you would receive more than the cost, add profit of 15,900. If I add profit of 15,900, I would get 78,600. This is the selling price. Yeah. What do they want? Amount of cash flow. So this much is the cash inflow. 78,600 will be the amount of consideration that will be received on basically sale of that particular asset. So answer is option D, which is 78,600 for question number 44. Yeah, come on. Now let us go to question number 45. Mithu Limited had investment as on 31st of March 2018 and 31st of March 2019, 10,95,000 and 10,82,000. During the year, interest received is 77. Oh, basically, it's again a cash flow based question. Let us open investment account. Don't try to do statement opening plus purchase. No, don't try to do like that. The paper's name is not corporate and management statements. It's corporate and management accounting. Yeah, better to do with the help of a ledger, which will help you understand very easily. So asset opening balance on the debit. So how much is the opening balance? 10,95,000. Closing balance on the credit. Buy carried down 10,82,000. Done. During the year, interest on investment received is 77,000. 77,000 worth of interest is received. That interest will go to P&L account and it will go to cash. So that's straight away cash inflow. Yeah. Which was used in writing down the cost of the value of investment. So they have not transferred it to P&L. They have written down the value. When you say written down, it is decrease. So they have written down. In here, they would have written by interest. You get that? They have not written it to P&L. They have written it here. How much is it? 77,000. But that will not change the nature of it. This is definitely inflow. You have received so much of interest. Definitely there is inflow of 77,000 to you. It is investing inflow. Now, what is happening? If there is purchase of investments, then cash flow from investing activity will be how much? Okay, come on, let us solve this. So 77,000, that's it. Is there anything else required? Nothing much required. Yeah, nothing else is there. So if I do 10,82,000 plus 77,000 minus 10,95,000. So how much is the purchase? Purchase here is 64,000. What is this? 2. Ouch. Cash. That is purchases made to the extent of 64,000. Done. So what exactly is the answer to this question? See, if you see purchases, it is 64 and interest it is 77. 64,000 is the outflow because of this particular activity and 77,000 is the inflow because of interest income. So the answer to question number 45 should be option C, which talks about cash inflow of 77,000 and outflow of 64,000. So inflow 77 and outflow 64,000. Yep. That's with respect to question number 45. Come on, now let us go to question number 46. The question looks a little big. You guys have a look at it. I'll have a sip of water, then we'll start. Come on, let us go to question number 46 here. 46 talks about following information were provided by a trading company to you. Very good. So they're asking operating activity. They have given us net profit. So basically they're wanting us to do it in the indirect method. Yeah, you remember indirect method? We start with operating profit. That is net profit as per P&L account. Add non-cash and non-operating items. Subtract non-cash and non-operating items to arrive at profit from, cash flow from operating activity. So my starting point is net profit 18,35,000. And what is happening during there? These items are there. Depreciation is written off basically. So when the depreciation is written off, what is happening? It is a non-cash expenditure debited to P&L account. When a non-cash expenditure is debited to P&L account, that expense has decreased my profit. Now what do? I need to add back to find my profit. So what do? I add back to find my cash profit. Depreciation which was wrongly written off, or which is, firstly it is not operation, secondly it is non-cash. Second one, goodwill written off. This is a non-cash activity again. When the goodwill is written off, you need not pay cash, but it is debited to P&L, which has decreased my cash profit. So in order to find cash profits, I'll add it back to my profits. So it's an expense wrongly written to P&L account. It's a non-cash or non-operating item debited to P&L account. So I'll write 50,000 plus. Next, provision for tax. Provision for tax is non-cash expenditure debited to P&L. If tax is paid, it is to be deducted. So provision for tax will be added back, tax paid will be subtracted. Provision for tax of 5,50,000 being non-cash expenditure is added back. Income tax paid is to be deducted. I'll write less tax paid. Shall I write income tax paid? How much is tax paid? 4,80,000 rupees. It's a minus item. And interest on investment credited to P&L account. Interest on investments will become my investing inflow. But if you write it in P&L account credited, it is like including it in the operating. So it is wrongly come in P&L account credit side. If P&L account credit side is increased, my profit would have been increased. So I would have to deduct it now. So I'll write here minus interest, which is non-operating income credited to P&L account. How much is it? 25,000. With respect to dividend, when the interim dividend is paid, it should have been deducted from your P&L what is there in the reserves and surplus and not in the balance sheet. Not in the statement of profit or loss, because dividend is appropriation of profits, not charge against profits. You get that? So it is after tax, that is basically not in the statement of profit or loss, but in the reserves and surplus statement. So I assume that this net profit, in this computation, they have not deducted this. If they would have deducted, I am supposed to add back. I'll assume that they've done it correctly by taking this in reserves and surplus and not deducting it from my statement of profit or loss. So I will not add back interim dividend. I will add back interim dividend if it was a case where interim dividend is subtracted from P&L account, which is an error. When they don't mention, I'll assume that they've not done anything wrong and they've done everything correctly. So this will become my cash flow from operating activities. To this, I was supposed to basically adjust changes in working capital, but no information regarding working capital here. 18,35,000 plus 1,08,000 plus 50,000 plus 5,50,000 minus 25,000 minus 4,80,000. So that gives me the answer of 20,38,000. So 20,38,000 should be my answer. So that's option B. 20,38,000. That's the answer to question number 46. Come on now, let us go to question number 47. Question number 47. When was the accounting standard board set? Accounting standards board was set in somewhere in April month. That is during the year 1977. That's the answer for question number 47. We have covered it in the chapter of accounting standards. Yes? Come on, let's go to question number 48. 48 talks about which of the sections of the Companies Act is required that the auditor, see, auditor is covered under what? Section 139 to section 148. Okay. Report, audit report is covered under section 143. It is a responsibility of the auditor. You get that? Okay. Whether in his opinion financial statements are in compliance with accounting standards. Same responsibility is there for board of directors under section 134. 134 is board's responsibility. 143 is auditor's responsibility. Section 143 subsection 3 clause E talks about the auditor's responsibility to tell that the financial statements are in compliance of accounting standards. So this is with respect to question number 48. Come on now, let us go to question number 49. What does 49 talk about? SMC. So whenever accounting standards are made applicable, they have not been made applicable for all the companies. Not all the accounting standards are applicable for all the companies. There is a classification called as SMC, non-SMC. SMC is small and medium companies. Non-SMC is not small and medium enterprise. So based on this, there is classification and then they'll tell which accounting standards are applicable to whom. So this SMC classification is based on being a holding or a subsidiary of everything, or the turnover based condition is there for 50 crores. So the question here is, which of the following is not included? It is not a condition, yeah, to be satisfied as SMC for the applicability of accounting standards. So these holding based conditions are there. So this is the correct option. It is included. For banking and financial institutions, it's not there. So this is also a valid point. Even it as 10 crore here, but the basic condition that is given in the applicability of accounting standard for and classification based on SMC and non-SMC category is 50 crore condition and not 10 crore condition. So it is definitely not option C. Option C is wrong. If the point was 50 crores here, then this would have also been correct option. Then we would have to go for some other option, or option D would have been none of the above. Done? So that is with respect to question number 49. Come on now, let us go to question number 50. Question number 50. Yeah. Which of the following international accounting standard is related to earnings per share? Earnings per share is given in Ind AS 33 or our accounting standard 20. Also talks about this. Yeah, if you are familiar with the numbers, you will get like 2-3 good marks in the examination questions. If they definitely ask somewhat like this. If they ask what is IAS 1, what is IAS 32, financial instruments, what is IAS 2, inventory. Yeah, something of that sort. Come on. Next one. Which of the following institute formerly was established as a registered company under the Companies Act? Yeah, this is with respect to ICWI, Institute of Cost and Works Accountant of India, was initially considered as a company under Companies Act 1944. That is before the Companies Act 1956 came into picture. Later in 1959, what they did was they treated it as a separate statutory organization. So till then it was actually a company under old Companies Act. That is Companies Act. This was registered as a company, registered company in 1944 only. In 1959, it became a separate institute, ICWA. Later, the name was changed to ICMA, Institute of Cost and Management Accountants. As of now, it is ICOAI, Institute of Cost Accountants of India. So that is with respect to question number 51. Come on now, let's go to question number 52. The Institute of Chartered Accountants of India is the second largest body of chartered accountants in the world. First one is CPA, that is with respect to in US when there are like multiple countries, multiple states have come together to form one. So it is the largest accounting body. So our country, whatever the body that we have, is second largest body. Next one, Association of Institute Certified Public Accountants. So this basically that AICPA Institute, or say American Institute of Certified Public Accountants and Certified Institute of Management Accountants, both together launched this yeah. So is launched in together by AICPA as well as CIMA. That's the answer for 53rd one. Come on, let's go to question number 54. Mandatory applicability of Ind AS to all the banks, NBFCs and insurance companies is from. This is a little debatable question. Okay, sorry for that small technical glitch. Now come on, let's go to question number 54. 54 talks about mandatory applicability of Ind AS to banks, to NBFCs and to insurance companies. When is it from? This is a little debatable question because the usual applicability of Ind AS starts from 1st of April 2015, that is at recommendatory basis, and then they start making it applicable to bigger, different set of companies on a phased manner. But that applicability is not applicable to banks, NBFCs and insurance companies. For banks, NBFCs and insurance companies, the applicability is little different. If you can recall, no, that existing provisions what are there for normal companies plus 2 years is applicable for NBFCs. That is, for listed NBFCs who's having turnover greater than 500, who's having net worth greater than 500 crores, to them it's applicable from 1st of April 2018. If it is an unlisted NBFC and the turnover is greater than 250 crores, then the applicability is from 1st of April 2019. And all the listed NBFCs are supposed to comply from 1st of April 19. So upfront for NBFC it is not 1st of April 18. Only for listed and greater than 500 crores it is from 1st of April 18. If it is greater than 250 or all listed are covered from 1st of April 19. Unlisted and less than 250 is not covered as on 1st of April 19 also. With respect to banks, it is applicable from 1st of April 14, but later they told we'll do it 1 year late. We'll do it from 1st of April 19. So they postponed it. And insurance companies, IRDA has made clear notification saying that we'll start following Ind AS from 1st of April 2020. So the applicability of Ind AS is different for banks, is different for NBFCs, and it is different for insurance companies also. The provisions are different for different items, and we'd have to choose different option as the correct answer for each of them. Whereas, as the only option with the latest date available is 1st of April 2018, so we would be selecting answer as option D, 1st of April 2018. However, the correct answer need not be 1st of April 18. It is different for different activities. It is different for NBFC, it is different for a bank, as well as it is different for an insurance company also. Among the options available, the latest date is 1st of April 18. So we are going by 1st of April 18. There is a huge story behind this answer and it cannot be answered in the span of a jiffy. Come on. Let us go to question number 55. Question number 55 talks about which of the accounting standard, Ind AS talks about consolidation. So Ind AS that talks about consolidation is Ind AS 110. Yeah, in accounting standards we have accounting standard 21 which talks about consolidation. In Ind AS we have Ind AS 110 which basically talks about consolidation. Come on. Now let us go to question number 56. Question number 56. What does question number 56 say? Question number 56 talks about a simplified financial statement that shows how much wealth has been created. Wealth income statement. How do we identify the wealth of the organization? By way of income statement. Financial performance of the organization, statement of profit or loss. Value addition to the organization, value added statement. And economical value addition to the shareholder, that will be economic value added. Market value addition, market value added. So that's with respect to question number 56. Come on, now let us go to question number 57. 57 talks about what is not an advantage. Not an advantage. So basically they're asking us what is the disadvantage of double entry system. It prevents and minimizes fraud. Yeah, that's an advantage. Helps in, like single entry system will actually create a lot of fraud. No, you can play around with quite a lot of things. And then helps in decision making. Yes, it does help in decision making. So that's also a valid point. Trial balance does not disclose certain type of errors. Trial balance does not disclose certain type of errors. Okay, trial balance only discloses one-side errors. If there is a two-side error, complete error of complete omission, debit is also ignored, credit is also ignored, then it cannot be identified. So that is a loophole in double entry system. So this is not an advantage. This is an in fact disadvantage, saying that though double entry system is so scientific and so modern, it can still not address certain type of errors, that is error of complete omission or a two-side error cannot be identified. it becomes easy for government to collect tax. That's definitely an advantage. Yeah. So that is with respect to question number 57. Let us now do question number 58. As per Companies Act 2013, the format of balance sheet is given under Schedule 3. Schedule 3 में Part 1 talks about balance sheet. Schedule 3 में Part 1 talks about balance sheet. Part 2 talks about statement of profit or loss. They've asked balance sheet. So Schedule 3 Part 1 is the answer. If it was statement of profit or loss, answer would have been Part 2 of Schedule 3 Companies Act 2013. Under Companies Act 1956, it was Schedule 6, which was later revised. But there the order was different. First is PL, then was balance sheet. Here it is first balance sheet, then PL. Come on, let's go to question number 59. Corporate Social Responsibility Committee. CSR committee that is supposed to be complied when that turnover exceeds 1,000 crores and then net profit is greater than 5 crores. All those conditions, when it is there, when you constitute CSR committee, it is supposed to have minimum of 3 directors, of at least 1 should be an independent director. So here also same thing. They've asked CSR committee's composition. It should be 3 or more directors. It should be 3 or more directors with at least 3 or more directors with at least 1 independent director. So the answer for 59th question should be option D. 3 or more directors should be there. The committee should have 3 or more directors, of which at least 1 should be an independent director. This with respect to question number 59. Let's go to question number 60. Financial Reporting Committee. This is basically constituted, or it belongs to UK. If you basically read that accounting bodies of several other countries, we had Australia, London, US, England, Wales, and quite a lot of things. In that particular chapter, we had this part. If we read that paragraph containing theory regarding this Financial Reporting Committee, we'll come across the option that it belongs to United Kingdom. Come on, let us go to question number 61. 61 talks about basically cost audit rules. This is basically made applicable from 30th of June 2014, or it came into force on 30th of June 14. We discussed Rule 14 regarding to this when we discussed cost audit, that chapter 2 in cost accounting part. Yeah, so that's with respect to this one. Question number 61, the answer is C. Let us now go to 62nd. 62nd one talks about CRA. Okay, there are several CRAs that we need to know. What does CRA 1 deal with? CRA tells us how to maintain cost records. What does CRA 2 deal with? CRA 2 deals with appointment. Whenever a cost auditor is appointed, appointment of cost auditor. Whenever a cost auditor is appointed, the report, I would say the file, e-form in which the filing of this particular appointment is made with the registrar is CRA 2. CRA 3 is the audit report. Who gives this to whom? Cost auditor gives this to company in this form. And once it is received, what should the company do? Company should file it with Registrar of Companies or MCA. That is CRA 4. So CRA 1 is about how to maintain cost records. CRA 2 is regarding the appointment of cost auditor. CRA 3 is the form in which the cost audit report is submitted by the cost auditor to the company. CRA 4 is the report that is filed by the cost auditor to be filed with the Ministry of Corporate Affairs or registrar by the company. Now what is the question? Which of the following form is used for filling cost audit report with central government? So who files it? The board files it with the central government in CRA 4. If it is cost auditor to board, then it would have become CRA 3. If it is the appointment order, CRA 2. How to maintain books of accounts? CRA 1. Come on, let us go to question number 63. 63, what does it talk about? The following steps are required for budgetary control. In the process of budgetary control, what and all do we need? Please do read question number 63. Come on, 63rd question. Which of the following steps are required? Do we need organizing for budgeting? Yes. Do we need manual? Yes. Do we need budgeting? Yes. Budget standard? Budget standard is after the budgetary control. That is a separate chapter altogether. But okay, so this covers few aspects. Let's see option B. Organization, yes. Budget manual, yes. Responsibility for budgeting, yes. And budget controlling also, yes. So that also sounds like okay, but there is something new here called as budget procedure. So this is something that I'm very happy about. That's nice. Objective of the budget, budget manual, responsibility, and budget standard. So what is the difference between option C and option A? So there is budgeting, there is budget manual, there is budget. Oh, is there no difference between option A and C? Option A and C is it repetition, budgeting, budget manual, responsibility, and budget standard. Option A and C is clear repetition. Option B sounds more nice now because there is budget procedure also involved in it. And the next one is organizing budget, organization of the budget. Okay, then objective, responsibility and budget standard. That's almost the same. So answer is about option B. Budget procedure is also quite important part of budgeting, and budget standards will come as part of your standard costing. That's the elongated version of our budget, and that's not part of our budgeting actually. Come on, let us go to 64th question. Which of the following will limit the activities of an undertaking? That is the bottleneck activity. The item which will stop us is a key factor analysis. I told you first we need to prepare budget for the key factor, then we'll do budget for the other items. Key factor was raw material availability, skilled labor availability, or plant capacity within the organization, or time, and quite a lot of constraints. So basically the answer is key factor. Yeah, come on, key factor is a more appropriate word than telling limiting factor and governing factor. Come on, let us go to question number 65. 65 basically talks about which of the following is the purpose of time recording. So time recording will include time keeping as well as time booking. Basically we tell how much time to book for that particular product and how much time to keep for that particular product. So the purpose is time keeping as well as time booking, and not just one among them. Come on, let us go to question number 66. This is our favorite part. We have done these ratios if you remember. So remember Salman, Abhishek and all. So they have basically given us if the capacity ratio. Let us see what exactly is capacity ratio. If you can recall, capacity is tested by doing A by B, actual by budgeted, and efficiency ratio. Efficiency is tested when we do S by A, standard by actual, and they are asking activity ratio. Activity happens when Bhai is over Bachchan. I told you this. So they basically asking us activity ratio. If you can observe, no, here in the numerator there is A, here in the denominator there is A. Can I write activity ratio is equal to capacity ratio multiplied by efficiency ratio? How come? If I do this way, it will become A by B multiplied by S by A. A will get cancelled, it will become S by B. And S by B is nothing but activity ratio. So basically, activity ratio is a product of these two. So I'll do 95% multiplied by 125%. So if I do 95 multiplied by 125, I'll get 11.875 as my answer. So the answer for this question is option C, 66th one. The answer is option C. If you mark that 66th one as option C, I'll take you to 67th one. Come on this note, let's get started and let's move on to question number 67. So the basic conclusion is activity ratio is capacity ratio multiplied by efficiency ratio. Hey, this is capacity ratio, not calendar ratio. Calendar ratio is something else only. Yeah, come on, let's go to question number 67. 67. Which of the following information is estimated for the year? Very good, 2021. There is normal loss in production will be 5%. So what does it basically mean? Input, output. Normal loss in the production is 5%. Okay, I'll write loss also. If there is an input of 100, there is loss of 5 and output of 95. Done. So that is what this point is basically telling us. Sales as per sales budget is 38,500 units. They're basically planning to sell 38,350 units, and closing stock will be 6,600 units. So totally they want 38,350 plus 6,600 minus the opening stock if any, which has been estimated to be 10% more than the previous quantity. So it is like this: opening plus 10% more than the previous. So previous is opening. So opening plus 10% is equal to 6,600. You get that? So opening plus 10% of opening basically. So opening is 6,000. How do you get it? 100 plus 10 is equal to 6,600. So if I do 6,600 divided by 110, I get 6,000. So my opening is 6,000. On that, if I add 10%, I'll get closing of 6,600. You get this? So I had told this to you previously when we discussed our sales budget. When we discussed our production budget, how much is the units that is supposed to be produced? Production budget. Production budget is sales plus closing stock minus opening stock. How much do you want to sell plus how much do you want to have at the end? Together, if you subtract what you have right now, you will understand how much to be producing. So you basically want to sell 38,350 units, and you want to maintain closing stock of 6,600 units, and you only have 6,000 right now. So how much should you produce? See, you want 38,350 to be sold, and you have 6,600 to be held at the end. So this much is your total requirement. Out of that, only 6,000 is in your hand as of now. So how much to produce? Production. Production is found as sales plus closing stock minus opening stock. If I do 38,350 plus 6,600 minus 6,000, I'll arrive at 38,950. That is my production. So my production is 38,950. So we have discussed here to get output, if input is 100, output is 95. It is not like you start production of 38,950 units and you will get 38,950 units as output. No, you need to start producing more so that after the normal loss you'll have 38,950 units left with you. So you need output of 38,950. So how much should be your input production? Basically we do cross multiplication. 38,950 multiplied by 100 divided by 95 will give you answer. 41,000 units of production should be started by you. If you start production of 41,000 units minus 5%, you will get 38,950 units. 38,950 units are produced. We have opening of 6,000. If I add 6,000, I will get 44,950. Out of this, you will sell 38,350 units and you will be left with 6,600 units as your closing stock. So this is the answer. Ouch. So this 41,000 is the answer for the purpose of production in this question. So input required for production is 41,000 units. So that is with respect to question number 67. And I'll leave you with this for a second so that if you want, you can actually pause that and then copy. And then I'll take you to question number 68. Come on. Let's now go to question number 68. 68 is on this side. Okay. 68. PUVI Limited provides you with the following information. For the quarter ending 31st of March 2020, expected sales 25 in January, in February 28, in March 30. What do you want? The amount collected from debtors in the month of March 2020. Okay, let us say how much will be collected from debtors. This is again budget. This is part of our cash budget to be precise. Roughly 40%, not 40, 40% of sales are cash. So if 40% is cash sales, how much will be credit sales? 60%. So 60% credit. So I'll write like this: January, February, March. So how much is our sales? 25, 28 and 30. Out of this, there will be certain amount of cash sales. How much is cash sales? 40%. 25 into 40%. That gives us 10. 28 into 40%. That gives us 11.2. 13 to 40%, that is 12. So how much is credit sales? Credit sales is, here it is 15, here 28 minus 11.2, that gives us 16.8, here it is 18. That is our credit sales. So cash sales means you will receive the cash immediately. Credit sales means you will receive the money later. But when is that later is the question. Read it further. Following month. Okay, 80% of the credit sales are collected in the following month. Now see here, collection. What will happen? Now for the month of Jan, there is 15 lakhs of credit sales. Out of this, 80% will be collected in February, 20% will be collected in March. I'll do 15 into 80%, 15 into 20%. You get that? They're asking us to do it for the month of March. So this is how it goes. And with respect to the 16.8, there will be no collection here. 16.8 into 80% will be collected in March, and 16.8 into 20% will be collected in April. And in the question they're asking how much of the amount is collected from debtors in the month of March 2020. So we're basically doing only for this much. Now tell me how much is 15 into 20%. We'll collect 3 rupees here, and 16.8 into 80, 16.8 into 80%, I'll collect 13.44 here. So what is the question about? It is amount collected from debtors only. They're not even including cash sales. So it is 3 and 13.44. 3 is with respect to sales made in the month of January, against which 20% is collected now, because 80% was collected in February. And with respect to sales in February, 16.8 credit sales, 80% is received in March, 20% will be received in April. Yeah, I'll read this again for you. 80% of the credit sales are collected in the month following the month of sales. So if in the January, if you do sales, 80% money will be received in February, and balance 20% will be received after 1 more month. That is like January, May, if you sell 100, 80 rupees will be received in February, 20 will be received in March. So January you sold 15. January you sold 15. Out of that 15 into 80% is here, this much is here. And then in March you sold 16.8. Some part is here, some part will be in the next month. So our basic answer is 3 plus 13.44. So the answer for this question should be 3 plus 13.44, that is 16.44 lakh. Come on, let us mark this answer. 68th one, the answer is option D. Come on, let's go to 69th one. Dash is a budget whereby all activities are re-evaluated each time. You remember Jimmy Carter, the US president, once told this, yeah, saying that we need to re-evaluate the budget every time without giving reference to what has happened in the past. So that is zero-based budgeting. We in fact discussed this as part of one of our MCQs. Yeah, zero-based budgeting in our class. Okay, zero-based budgeting is where we don't give any reference to past and we substantiate every rupee that we're going to spend now. So zero-based budgeting is the answer for re-evaluated budget that we do and discrete levels of each activity. Done? Come on, let us go to question number 70. Question number 70. Unlimited as net working capital. Net working capital is excess of current assets over current liabilities. Okay. Total liabilities is 225 lakh. Non-current liabilities is 140 lakh. What is current ratio? Very easy. Come on, let us start doing this. So they are given net working capital. Working capital is current assets minus current liabilities is equal to working capital. So and they have also given us total liabilities is given, non-current liabilities is given. So total liabilities may 225, two parts. Current liabilities, non-current liabilities. Non-current liabilities is 140. So how much is my current liabilities? 225 minus 140. That gives me 85. So I'll write current assets, which I don't know. From this, if I subtract 85, I'll get my working capital of 119. So my current assets is equal to 119 plus 85. If I add 119 and 85, I'll get current assets of 204. I know my current assets is 204 and my current liabilities is 85. My current ratio, it is very easy to do now. Current ratio is equal to current assets by current liabilities. So current assets is 204, current liabilities is 140. If I divide 204 divided by 140, my answer will be 1. Wait, did I miss out on something? Sorry, this is 85. Current liabilities is 85. So 204 divided by 85, my answer will be 2.4. So I can write my current ratio is 2.4 or current ratio is 2.4 is to 1 or 2.4 by 1, anything. That's my answer. The ideal current ratio is 2.4. If you have better current ratio, it's good for you. However, for the purpose of taking loans from the bank, 1.33 should be the ratio because after you borrow, it will go little up down. Yeah, 1.33 is good enough if you are borrowing. For the purpose of bank, they take it only to the extent of 1.33 is to 1. Yeah, but ideal ratio is 2. Come on. This with respect to question number 70. Come on, let's go to question number 71. The company's purchases 385 lakhs. 385 lakhs. Purchases are 385 lakhs. Sales are 510 lakhs. Closing stock is 58. Okay. If the gross profit is 25%, what is stock turnover ratio? Come on, let us solve this. Stock turnover ratio. There are two formulas for stock turnover ratio. First one, we can basically take sales or we can take COGS also. So we can do either sales by average stock or COGS by average stock. Whenever information is available, we should go for COGS by average stock. Whenever the COGS information is not available or it is not possible to compute the profit to arrive at COGS, then we would go by sales. In this question, the profit is available and the closing stock data is also available. So we would be following COGS by average stock formula to compute this particular answer. Come on. What I'll do in this particular question is, I'll first draw a small trading account so that we'll get all the necessary information that we need and then we'll go ahead and then solve this question. So firstly, there is purchases 385 lakhs and there is sales 510 lakhs. There is closing stock 58 lakh. There is gross profit of 25% on cost. So if it is 25%, that is 1 by 4 on cost. If it is 1 by 4 on cost, it can be regarded as 1 by 5 on sales. So 1 by 5 is 20% on sales. So if I do 510 divided by 5, I told you when she is over, like when she is sold, you will be over her 1 by x, and she'll be with someone 1 by x plus 1. You get that? So 102 is our gross profit. So we have sales, closing stock, GP, purchases. Can we find our opening stock as balancing figure? Yes, we can. 510 plus 58 minus 385 minus 102. So you would get 81 as your opening stock. So it's easy for me now. What is my stock turnover ratio? I should take my COGS. How do I find my COGS? Sales minus gross profit. 510 minus 102. Divided by average stock. What is average? Opening plus closing divided by 2. 81 plus 58 divided by 2. Yeah. How much is 510 minus 102? 510 minus 102 is 408. 81 plus 58 is 139. If I divide it by 2, I'll get 69.5. So 408 divided by 69.5 gives me stock turnover ratio of 5.8705 times. So meaning the amount of stock that I have now will get exhausted 5.87 times. If I do this 12 months divided by 5.87 times, or 365 days divided by this time, I'll get my inventory holding period. For how many days will I hold my inventory once? One part of inventory that comes into my organization, how many days will it stay in my organization can be found that way. So the answer is 5.87 times. That is with respect to question number 71. The answer is option D, 5.87 times. Next we'll go to Mahi Marre. Yeah, come on, let's do Mahi. Question number 72. The closing stock is 648 lakh, prepaid expense is 32 lakh, total liquid assets is 1830 lakh. See, we have this definition of current assets, liquid assets. Liquid assets is current assets minus stock minus prepaid expense. So basically they've given it all here. They've told liquid assets is 1830 lakh. So if I have to find 1830 is my liquid assets, and they have to tell us how much is current assets. My current assets is equal to, my liquid assets is equal to current assets minus stock. They have told stock is 648 and they have told prepaid expense is 32. So I can easily find my current assets, that is 1830 plus 648 plus 32. That gives me current assets of 2510. Correct? And they have told liquid ratio is 1.5. Okay. Liquid ratio is found as liquid assets divided by current liabilities. Liquid assets is current assets minus stock minus prepaid expenses. Now liquid ratio is 1.5:1. That is in the form of ratio proportion. If I write it in the terms of fraction, it becomes 1.5 divided by 1. Anything divided by 1 is the numerator only. Yeah. So I'll write 1.5. What if the numerator is also 1? Then the answer is 1. Numerator only, no? So 1.5 is equal to liquid assets. Liquid assets is 1830. And I don't know my current liabilities. That is what we're trying to find. So my current liabilities, if I send this denominator to my LHS and then bring that LHS to my denominator, it becomes 1830 divided by 1.5. Then I'll have current liabilities of 1220. So my current assets is 2510. Current liabilities is 1220. They're asking how much is working capital. Working capital is current assets minus current liabilities. My current assets is 2510 and my current liabilities is 1220. So the answer is 2510 minus 1220, that is 1290. So my working capital is 1290 lakh. That is with respect to question number 72. Yeah, come on. Let us now go to question number 73. Which of the following is not included in activity ratio? What of this is not activity ratio? Activity, I told you, is in the normal course of operations. Sales to capital employed, when you do sales is involved, it is operating ratio. It is activity ratio. Debtors to turnover, it is in the normal course of operations, operating ratio. Proprietary ratio, when you find profit on assets, that is not part of your activity ratio. That is not for the purpose of evaluating the operations. So that is not proprietary ratio. Working capital turnover, turnover is again in the normal course of operations, that is operating. So that is with respect to 72nd one, sorry 73rd one. 74th one, ideal current ratio will be 2:1. However, when it comes to banks, 1.33 is the ideal one. Come on, let us now go to question number 75th one. Which of the following set of reports is classified accounting into content? So what is the basic, this is basically our corporate financial reporting. If you remember, I told you descriptive, tabular and graphical parts are the basic ways in we segregated. Descriptive, there will be paragraphs, tabular, tabs, bar tab and all other thing, and then graph, chart and other thing. So these are the ways in which we can classify our reporting requirements into. 75th one is from the chapter corporate financial reporting, small chapter but decent amount of marks from that chapter if you can see. 75th one is done. Come on, let us now go to question number 76. What does 76 deal with? Which of the following is not a step taken in implementation of effective management reporting program? In the management reporting program, we need to discover what should we report on. We should have an access point where we get all the data, and we basically, after we report, we take the feedback. I told you we took feedback from our client multiple times as to meet their MIS requirements. Once we had the entire thing set, there should be no problem. Finance is something that will never ever come in the management reporting part. Yeah, finance is something that's separate altogether. Yeah, it's not part of our management reporting considerations. Done. Low margin of safety. If you want to recall, when we discussed the chapter of marginal costing, I told you sales, which will have two components, break-even point, margin of safety. Each will have two components, variable cost and contribution. This will also have two components, variable cost, contribution. Contribution will have two components, fixed cost, profit. Here also fixed cost, profit. Margin of safety may there is no fixed cost, and BEP may there is no profit. So if the fixed cost is more, no, MOS will become less. So what is it? Low margin of safety usually indicates what? The profit has been reduced. Why did the profit reduce? Because of high fixed overheads. So the answer is high fixed overheads will reduce the margin of safety. When your fixed cost here increases, no, then what would happen? Your contribution here increases, BEP will only take longer time. It will take more time to just break even. When you take more time to break even, the amount of profits that you make will reduce. So margin of safety will basically reduce. Margin of safety is PVR and profit relationship. You remember, we never mugged up any formula. We did entire marginal costing using the technique of that chart or the circle that you people can actually remember. We've done a separate detailed video in 3 parts on marginal costing. If you want, go back to see it to understand each part of the formula without mugging up before the exam. Logic of it. That's how you need to remember, and that will save quite a lot of time in the examination. Let's go to question number 78. The following is not a method for transfer pricing. Yeah, transfer pricing is when the goods are imported from some other country and you have an associate there, you might import it for a lesser price from that country, trying to deviate profits, either to show more profits in that country or to show more profits in this country. In order to evaluate this and then stop this process of happening, no, under CBDT, Income Tax Act has included something called as transfer pricing provisions. This is something called as full cost transfer pricing, negotiated transfer pricing, opportunity, all this is there. But standard transfer pricing is something that is never ever mentioned in section 91, 92 of our Income Tax Act 1961. This is also part of our taxation syllabus. So standard cost pricing, transfer pricing is something that's never ever there, and that's not something that is to be dealt here. Or this transfer pricing also deals with transfer pricing in the normal course from one organization, within the departments. When you transfer goods, no, what is the price at which you should send? You can send it the full cost, or you can negotiate both of you, ensuring that both of you will make decent profit, or the price at which you can sell outside. That opportunity costed transfer pricing is also possible, but standard cost transfer pricing is something that's never specified. Oh, sorry, this transfer pricing within the department is the reference here, not reference to the taxation wala transfer pricing. But in our syllabus copy, they've wrongly mentioned transfer pricing regarding to that one. I used to always wonder why, but never to talk about it. The point here is the transfer pricing here, what is referred is the transfer pricing between one department and another, and that is regarding standard transfer cross pricing is not mentioned anywhere. So whereas full transfer pricing, negotiated transfer pricing, opportunity transfer pricing is something that is usually dealt with within the organization for the purpose of determining transfer prices. Yes, let's go to next one. 79th one. Following data of M Limited is given. The sales in the first 6 months, sorry, cost of sales in the first 6 months, cost of sales in the second 6 months, as well as the profits. Basically, when they've given profit and sales, we can actually find sales here. What will be their sales? Total 80 lakh will be their sales in the first 6 months, and 90 lakhs will be their sales in the next 6 months. So if we add profit and cost, we get sales. cost plus profit is sales. Okay, they're asking fixed cost. Simple guys. Yeah, we just need to start doing this. Do we know this formula? Profit volume ratio is equal to change in contribution divided by change in sales. We know no contribution and sales are contribution divided by sales is PVR. That proportion of contribution which is collected from sales is this. The difference will become our PVR. Now PVR will be change in contribution. Change in contribution is basically we know contribution is equal to fixed cost plus profit. Correct or not? Can I write fixed change in fixed cost plus change in profit divided by change in sales? Fixed cost, as we've always learned, it remains constant and it doesn't vary with the level of production. So fixed cost can't vary. So the ultimate point what I'm trying to tell you here is profit volume ratio is change in profit divided by change in sales. So how much is the change in profit here? 10 lakh say 14 lakh, 4 lakh. My profit changed by 4 lakh. How much is my change in sales? 80 lakhs to 90 lakhs, 10 lakh. So my profit volume ratio is 40%. 40% of the money that I collect is towards my variable cost. Come on, let us go ahead and then solve this with the help of this to basically identify our fixed cost. Now sales. Let us see for the first 6 months. Yeah? First 6 months. Next 6 months. Sales for the first 6 months is 80 lakh. Yeah? It will have two components, variable cost contribution, and they've told PV ratio is 40%. So if you remember our formula, on the sales when we apply 40% it will come to contribution. We used to do that chart, no? I'm doing the same thing now. Nothing new. 40% of 80 lakh. 80 into 40% should be 32 lakh. So I'll write here 32 lakh. This will have two components. One component is fixed cost, other one is profit. Profit is given as 10 lakh. So fixed cost will be 22 lakh. If things are fine, no, in the next part of the year also fixed cost should be 22 lakh. Why? It doesn't vary, no. It should be equal for first 6 months and second 6 months. Let's however see. In the next 6 months, our sales is 90 lakh. So this will have two components. Variable cost contribution. Contribution is 40% of sales. It will become 36 lakh. This will have two components, fixed cost and profit. They have told profit is 40. So from 36, when I subtract 14, I'll get 22 lakh. So basically what we did is perfect. Why? Fixed cost will remain same irrespective of level of production. It is divided based on the time here. So 22 plus 22, it becomes 44. So for the total year, it is 22 lakh in the first 6 months, 22 lakh in the next 6 months. So the total fixed cost is 44 lakh. $44 lakh is our total fixed cost during the year. So this is the answer with respect to question number 79. Let's now discuss question number 80. Which of the following are key factors? Let's see what are the key factors. Key factor analysis, I told you, items which can affect our performance of the organization, which have constraints. Yeah. Sales value quantity. Sales value quantity can be a key constraint. Like they might tell like, okay, fine, only these many number of units can be sold. There is a limited demand for the product. Possible. Raw material quantity. Raw material can be available in limited quantity to the organization. Then raw material quality is not a key factor. Quality of the raw material is never a key factor. Labor hours availability. We might have limited number of people with us who might be able to work for limited number of hours. That is a limitation. That is definitely a key factor. Plant capacity can be a key factor, meaning the capacity of plant can be to run for only so many hours, or the land that we have is limited to have only 3 assets inside it, or something of that sort. Number of plants used in the manufacturing process. Yeah. So the answer should be somewhere around 1, 2, 4, 5. Cost of production is also not the key factor. So do you have anywhere the answer which says 1, 2, 4 and 5? Number of plants is not a key factor because number of plants can be installed in the manufacture process. Number of plants used, that's not a key factor basically. So the answer is 1, 2, 4 and 5. Do you have anywhere 1, 2, 4 and 5? Option B, which talks about 1, 2, 4 and 5 is the key factor analysis, or the key factors that can affect our budgeting process. So first we need to plan for these key factors and then we do the budget for the rest of the items. So this is with regard to question number 80. Let us now go to question number 81. 81 is, okay, list 1, list 2. Match the following. Okay, let's do this, match the following. Come on. Profit earned. When the profit is earned, it is margin of safety multiplied by PV ratio. Why? PV ratio, when we take for margin of safety, we'll have two parts, variable cost, contribution. Contribution will have two parts, fixed cost, profit. For margin of safety, there will be no fixed cost will become 0. So profit will become contribution. So contribution by sale is nothing but profit on sales. So profit on sales is margin of safety in the case of this case. So profit earned is contribution. So P1. So for P it is 1. Sorry, it is 2. Profit earned is margin of safety multiplied by PV ratio. Classification of costs into fixed and variable cost. This is made under marginal costing system. Under absorption costing, we absorb everything. Yeah. So classification of cost into fixed and variable is option 3, marginal costing. Both fixed and variable costs are charged to the product, that is absorption costing, option 4. Sum of fixed cost plus profit. Contribution is selling price minus variable cost or contribution plus fixed cost. So S is 1, contribution. So it should be P2 Q3 R4 S1. P2 Q3. So it is Q4. So answer is not option A. Then option B. P2 Q3 R4 S1. It is option B. Option B is the answer for question number 81. P2 Q3 R4 S1. So we're done with 81st one. Come on now, let us go to question number 82. 82 is on this side. So following is the information provided by S Limited information provided by S Limited are given below. Okay, our favorite chapter, marginal costing. When sales are rupees 120 lakh, then calculate this much. Okay, they have given details regarding break-even point. Break-even point means 60 lakh. How much is the sales? They have given it as 60 lakh. This will have two components, variable cost, contribution. Contribution will have two components, fixed cost, profit. It is BEP, so profit will be 0. Entire amount will be fixed cost. Fixed cost, they have given it as 24. 24 plus 0 is 24. So in this question, contribution is 24. So what is the relationship between BEP and contribution here? 24 divided by 60, that gives me 0.4. That is our PV ratio. That is 40%. Now using this data, can I solve this particular question where the sales are 120 lakh and they want to know how much is profit? So there is sales of 120 lakh. It will have two components, variable cost, contribution. Contribution will be 40% or 0.4. So if we do 0.4 into 120 or 120 into 40%, I'll get 48. This will have two components, fixed cost, profit. Fixed cost doesn't vary with the level of production. That is the reason it's called as fixed cost. That is of 24. So how much will be my profit? 48 minus 24 will give me 24. So my profit is 24 lakh. No wonder it's a very nice chapter to do. Come on, 82nd one, the answer is option C, 24 lakh. Let us now go to question number 83. In activity based costing, we find cost drivers and then the entire cost is allocated based on the cost drivers. If it is marginal costing system, we straight away divide it by number of units or we straight away divide it by hours per unit. Whereas under activity based costing, we identify activities, we identify cost driver. Now electricity, cost driver is now to say number of units of electricity used. Now rent, floor space. You get what I'm trying to tell? And then we based on this factor, we identify cost drivers, the item which will drive that cost, and then based on that we allocate the cost to each of the production item or each of the process of production. So the answer is cost driver. When activity based cost comes into picture, the word is cost driver. Come on, let's go to question number 84. The inspection of products is an example. Inspection can be done at unit level of production. If it is batch level, we cannot do inspection for each item. We just see the batch as a whole. And product level is something which is not again part of this conversation. So when we say inspection of products, it's unit level activities. You get that? Come on. Let us go to question number 85. Which of the following is not a valuation approach? We remembered that there are three valuation approach: asset based valuation, income based valuation, and market based valuation. So asset, income, and market are there. What is not is the question. What is not? Expenditure approach is something that we've never heard of. Yep. Come on. Let us go to question number 86. This is a purely financial management question. We'll solve it. A deposit to be made on 1st of January 2020 into the bank that will earn 7% compound annually, 7% interest compounded annually. It is desired to withdraw 60,000 on 31st of December 2023. So on 31st of December 2023, I want 60,000 rupees. and on 31st of December 2025 I want 1 lakh rupees. So how much should I invest now? I should definitely be investing lesser than 1 lakh 60,000 plus 1 lakh. 60,000 I wanted in 2023, 1 lakh I wanted in 2025. I should be investing something lesser than that. How many years should I investing or should I be investing it for? Now if I invest in 1st of January 2020, entire 2020, 2021, 2022, 2023. So this investment to get 60,000 rupees should be for 4 years. If you want 1 lakh at the end of 25, investment today should be made for 20, 21, 22, 23, 24, 25. It should be made for how many years? 6 years. Second investment should be made for 6 years. So you should basically find a present value interest factor for 4 years and 6 years at 7%. But you need to thank institute here because they've given the data straight. If not, you would have been taking calculator doing 1 divided by 1.04 equals used to do it 4 times. 1 divided by 1.07. If you do it 4 times, you get 0.7629. 1 divided by 1.07. If you do it 6 times, you get 0.6663. So they've given it. So you basically want 60,000 after 4 years. So you do 60,000 multiplied by present value factor for 4 years. How much is it? 0.7629. And you take up 1 lakh rupees. And on this 1 lakh again you do 0.6663 because that is for 6 years. Whatever the answer you get, if you total, let's see, that should be your answer. 60,000 multiplied by 0.7629. That gives you 45,774. I'll add it to the memory. I'll do 1 lakh multiplied by 0.6663. That would give me 66,630. Once I add that also to memory, if I check my memory, it is 1,12,404. If I invest 1,12,404 today, that is on 1st of January 2020, at 7% interest compounded annually, I can withdraw 60,000 on 31st of December 2023, and I can also withdraw 1 lakh rupees on 31st of December 2025. So this is a pure FM question and not very difficult. We can definitely solve it. So the answer for this question is 1,12,404. 1,12,404 is option B. So this is with respect to question number 86. Let us now go to question number 87. Shall we? Come on, question number 87. Cost of sales. So if you remember the cost sheet format, cost of sales comes at the bottom. Selling and distribution overhead comes just below that, just above that. So they're subtracting that and then they're adding closing stock, opening stock minus. So they're going backward basically. When they go backward that way, where do they end up? They end up with cost of production. So whenever you go backward that way, you end up with cost of production. If you can see, they do cost of production plus opening stock of finished goods minus closing stock plus selling and distribution overhead will give you cost of sales. That's downward. So they're going backward. So the minus will become plus and plus will become minus and you'll end up with cost of production. So this is a pure understanding of cost sheet format. Mein backward if you go, you'll get cost of production. So that is the answer to question number 87. Let us now get into question number 88. So what does 88 talk about? So 88, they've given information. Following information is provided by B Limited. Last EPS is 75. Company's dividend payout is 40. So what exactly is the dividend of the company? So dividend per share is equal to earnings per share multiplied by dividend payout ratio. So that is, if the 75% is the earnings, if they give 40% of the earnings, then it will become 75 into 40%. 30 rupees is their dividend for the current year. Yeah. Required rate of return on equity is 18%. This is KE. Cost of equity is 18%. They are asking capitalization of earnings model. What exactly is the valuation? We know the formula. PO is equal to D1 divided by KE minus G. So what is D1? This DO basically. DO is 30. They basically are expecting a interest hike. Sorry, there is increase. So what is the rate of growth expected? 10%. If I do plus 10%, I will get D1, 33. Current year the dividend is 30, the growth rate expected is 10%. That is retention multiplied by rate. G is equal to B into R. B is the amount retained and then R is the rate of return on the retained amount. So that is 10%. So basically in the next year you are expecting dividend of 33 rupees. So 33 rupees is the dividend you are expecting. Cost of equity is 18%, growth is 10%. 33 divided by 8%. That should give your share value 8%. So present value of the share is 412.50. Again a pure FM based question, but this is a common portion which is there in FM as well as your CMA part. So this question can come in FM also, this question can come in CMA paper also. However, the answer for this question is 412.5. That is for question number 88. Come on now, let us go to question number 89. 89th question. Yeah, P Limited has 12% debentures 40 lakh. Okay. 12% debentures is 40 lakhs and there is 13% debentures of 60 lakh. What do they want? If the combined corporate tax rate is 30%, then cost of debt after tax will be how much? Oh guys, simple. Now tell me, how much is the interest that you're supposed to pay? On 40 lakh you paid 12%, that comes to 4.8, and then on 60 lakh you pay 13%, that comes to 7.8. You can prepare the table rating weights and then multiplication. That is complicated. We can do it way more simple terms also for this. I'll show it to you how. 7.8 plus 4.8 basically gives us 12.6 lakh is the expenditure by way of interest. Now whenever there is interest as an expense, there is something called as tax saving that's happening, because interest is expense. Because of interest expense, profit will decrease and you pay lesser tax. So the tax saver is something that's supposed to be deducted. So straight away, how much is the tax rate? 30%. I'll deduct 30% tax savings. So that give me net of tax basically 12.6 minus 30%. So that will give me 8.82. 8.82 is basically my what exactly do you say? Dividend. Sorry, combined tax rate of this particular item. That should be the answer. How do we get 8.82%? Simple. It is for 100 lakh, no? For 100 lakh, 8.82. How much is the percentage? It is simple. 8.82 divided by 100 into 100. 8.82 is the interest that you pay net of tax. So 8.82 divided by 100 into 100 will give you 8.82 percentage only. Because total for 100 lakh you pay 12.6 lakhs as interest. 12.6 lakh may say 30% you get tax savings, so we subtract that, because that money you will get by tax savings. So the net interest that you pay is 8.82 lakhs for 100 lakhs. So 8.82 lakhs for 100 lakhs is 8.82 percentage. So the answer is 8.82. Yes, this is with respect to question number 89. Come on, now let's go to question number 90. Which of the following is the Ind AS deals with financial instruments? We discussed this in valuation chapter. Ind AS 32 deals with financial instruments. Financial instruments, two parts. One is equity, other one is financial liability. Equity shares was equity, as however preference share and our debentures were financial liability. Yeah, that's the same thing that we were discussing, or something same thing that I referred to now. So this is with respect to question number 90. Come on, now let us do question number 91. Question number 91 talks about following information is provided by A Limited. So what do they want? They basically want intrinsic value per share. Okay. Intrinsic value per share is nothing but our net asset method. Under net asset method, what do? We find the net assets and then divide it by number of equity shares. That will give us intrinsic value, correct or not? Now further, net assets is equal to assets minus liabilities. And I told this to you, when we prepare balance sheet, we'll write assets here, liabilities here, capital here. If we take assets minus liabilities, we get net assets. That is nothing but capital. You get what I'm trying to tell? So instead of writing that as net assets that way, can I write it as my combination of preference share capital plus equity share capital plus reserves and surplus as my net assets? Yes. Net assets should be equal to preference share capital plus equity share capital plus reserves and surplus also that way. So what is my net assets in that case? 200 plus 600 plus 270. So 200 plus 600 plus 270 will give me 1070 as my net assets. So my net assets is 1070. And they've told in this particular question, is it so? Yeah, 1070 is my net asset. And we know that net assets is assets minus liabilities. And net assets in this case is 1070. We don't know our assets in this case. That's the reason this entire hangama is happening. And total liabilities. Can we find total liabilities? They've told external liabilities is 480. So I'll take my liabilities as 480. Sorry. Screen modality. 480. So if I have to find my assets, it will become 1070 plus 480. Plus 480. That gives me 1550 as my assets. So now I know my assets. If there are any adjustments to these assets, I can do that minor adjustment and then end up finding my intrinsic value. Let us continue reading. What is we told? Normal rate of return normal rate Normal return earned on market value of fully paid up equity shares of the same type of the company is 15%. Nice. Assume that 2% of the assets are worthless. So out of this assets of 1550, 2% of the assets are found worthless. Oh, so what will I do? My net assets that I found previously is 1070. Out of this, I'll write less loss. That is assets which are worthless is 2% of 1550. Yeah, into 2%, that is 31 is basically loss. It is of no use. And my net asset should not include preference share capital, because we are trying to find the value, intrinsic value per share. When you find the intrinsic value per share, I want the value only relating to equity shares. That is net assets available to equity shareholders. Then if I divide by number of equity shares, I'll get intrinsic value per share. So I'll subtract the preference share capital which I previously took. Sir, if you're subtracting here, then why did you took here? Here I need to take because I don't know the value of my assets. I only know that 2% of my assets is not required. If the 2% of the assets is not required, condition is not given, here I wouldn't have taken 200. I would have taken 600 and 270 and then close the issue. Done? So then how much will it become? 1070 minus 31. 1070 minus 31 minus 200. That gives me 839 is the net assets available to equity shareholders. If I divide this by number of equity shares, I'll get my intrinsic value. How many equity shares do we have? 60 lakh equity shares. So I'll divide it by, this is also in lakhs, right? So I'll write just 60. So if I divide, how much will be my intrinsic value? 839 divided by 60, I'll get 13.98 as my intrinsic value. So this is the answer. There is a little bit of information around here, that 15% and all, which is actually not required in the answer, but still given. Yeah. However, the answer for this question is 13.98. I'll show you the answer to you a little more, so that you can copy. 13.98 is the intrinsic value for question number 91. Come on now. Let us go to question number 92. Question number 92. Which of the following is not a method used to value the shares? Net asset method is used. Based on the dividend method it's not a method used in valuation of shares. Yeah. So which method is not used? We use net asset method, that is also called as intrinsic value. We use the dividend valuation method. We use earnings method, that P method, wherein we take MPS, market price per share and earnings price per share, P multiple. Yeah, we did quite a lot of MCQs on this topic in our discussion. And net realizable value method is not there. Net realizable value method is a method used to evaluate inventory and other current items, not shares. Yeah, come on. Let us go to question number 93. Question number 93. Which of the following methods of valuation is suitable or ascertaining the market value of the shares quoted in the recognized stock exchange? Now, if you are trying to buy shares in the market on a stock exchange, which method will you use? Will you use net asset method? No, you will not be asking for the company's balance sheet to find the intrinsic value. I told you, whenever you want to trade a company share, you can straight away tap on that company's details, and then its EPS and a PE multiple will be given there only. So when PE ratio and earnings per share is given, multiply that and you will get MPS. So if your market price is lower than that market, so if the price that you arrive as EPS multiplied by PE ratio is less and market price is more, then the share is trading at a premium. You need to sell that particular share. You should not hold it for long. However, if the PE multiple that you have, when you multiply it by earnings price per share, the price that you arrive at is more and the market price of the share is actually less, then the share is trading at discount, you have to buy that particular share. However, this P multiple consideration is not the only consideration. There are a lot of other considerations also. The legal obligations against the company, the customer sentiment, or what exactly is happening with the company. Has any scam is being proved? Is there any case pending against the company? Has any CEO left the company? Or quite a lot of other things will also come into picture. So those are other considerations. But as we discussed during our valuation chapter, I told that is the basic thing that you can keep in mind whenever you want to buy or sell a company's share. So the suitable model will be PE model, that is option C. Price earnings ratio model is the easiest one, and majority of the people usually use that formula for computation in, or say, to trade a share which is in the market. Let's now go to question number 94. Question number 94 talks about capitalization of average profit and capitalization of super profit. Yeah, the formula for goodwill under capitalization of average profit. See, goodwill under capitalization of average profit is not average profit by normal rate of return. It is average profit multiplied by normal rate of return minus normal capital. Many of us forget to write this word normal capital. We straight away write average profit divided by normal rate of return is goodwill. No. Goodwill is to be found as average profit minus normal rate of return minus normal capital, not to forget. Why is this? Sorry, minus actual capital. Because goodwill usual formula under capitalization method is normal capital minus actual capital. Actual capital employed will be given and normal capital is found as average capital employed by normal rate of return. Come on, let us see what data is given to us. Average profit is 15 lakh 60, super profit is 4 lakh 80, capital employed is 90 lakh. It's in the order only. So goodwill is equal to, how much is our average profit? 15.6. I am doing everything in lakhs, divided by normal rate of return, that is given as 12% was. Yeah, minus actual capital employed is the item that's given third, that is 90 lakh. 90. So how much is my goodwill? 15.6 divided by 12%. That gives me 130 minus 90. So goodwill is equal to 40. Under which method? Average profit method. Under super profit method, goodwill is super profit divided by normal rate of return. Sir, why don't we subtract actual capital employed here? Super profit itself is found as actual profit minus normal profit. So there is already difference taken. Normal profit is profit on the normal capital. So there is already the difference is taken. That is the reason we don't multiply actual capital here. Whereas in the case of goodwill under average profit method, we have to do it because the difference is not taken. You get that? So how much is our super profit? Super profit is given second, that is 4,80,000. I'll write 4.8. Normal rate of return is 12%. So if I do 4.8 divided by 12, yeah, it becomes 40 again. So under super profit method also it is 40 lakh. So the answer is 40 lakh and 40 lakh. Yeah, many of us pound on this question and forget this actual capital subtraction and then only do 15.6 divided by 12%. I've seen majority of the students doing this mistake. Yeah, 130. They straight away write this here as 130 and this as 140. So many of them will go for 130 and 40. That is not the answer. The answer is 40 and 40 because the goodwill formula under capitalization method of average profits is average profit divided by normal rate of return minus actual capital. Don't forget that second part. Initially in the third question or something that we did regarding share capital, there also I told you people usually tend to do mistake and same is the case here also. So get along with this one and then do it correctly. So let's now do question number 95. So 94th one is done. So the answer is option D, 40 lakh in both the cases. Come on. In fact, super profit method and average profit method capitalization, they're like one is vice versa of the other. So usually you should get the same answer, other things being normal. Yeah. Section 247 or registered valuer. Whenever the registered valuer is supposed to be appointed, we basically keeping in mind corporate governance, no? Audit committee should at first place appoint it. If it is there or if the audit committee is formed under section 177. If the audit committee is not formed, means the company is not covered under audit committee regulations, or the audit committee passes on the responsibility to board, only in that case it will be done by the board. So the first person who is entitled to do it is audit committee. If the organization doesn't have an audit committee, then it will fall in the hands of the board of directors. You get that? Come on, let us now go to question number 96. Question number 96, okay, CAPM model, purely FM based question. So how do we find it? So we basically find the return on an item as risk-free rate of return plus beta into market rate minus risk-free rate again. So they've given risk-free rate as 8% plus beta is given a return abroad actual rate. Beta is to be found. Oh, they've asked us to find the beta. So I'll write beta into what is the market rate? 15%. What is the risk-free rate? Again, risk-free rate is the actual return is 8. Okay, this is 8, and then actual return on the portfolio that you earned is basically 18. So 18 is equal to 8 plus 15 minus 8 is 7. 7 beta. So beta will be 18 minus 8, 10 by 7. Am I right? So if I do 10 by 7, how much do I get? 10 divided by 7. So I get 1.4285. That's my point answer. So they're basically asking us to find the beta here. So the answer is A. 1.43 is the answer. CAPM model, the formula is return on the portfolio is risk-free rate of return plus beta multiplied by RM minus RF. They've given beta is not given in this case, and risk-free rate is 8, market rate is 15, and return on this particular portfolio is 18%. Yeah, we substitute to find the answer. It's just simple substitution question. Come on, let's go to question number 97. 97 talks about the relationship between risk and return. Here, no, market rate and risk-free rate. The difference is basically risk that we are assuming. At that risk, at the market sensitivity activity index we are basically supposed to earn. So the relationship between the risk and the return is basically given by CAPM model. Yeah, no better model gives us the data regarding that. Come on, let's now go to question number 98. Following are the details of beta limited. Oh, risk. Okay, what do they want? They've given us equity share capital, 8% preference share capital, PE ratio, dividend ratio, corporate. They basically want us to find the earnings per share. Simple one. And again, pure FM, but can be asked in accounts also. They've given profit before interest and tax, which is our starting point. So I'll write PBIT, that is 590. I'll write everything in lakhs. So I'll write less interest. So what is the interest here? 12% of 250. 250 into 12%. 250 into 12%. That will give me 30. If I deduct 30 towards interest, I'll get profit before tax of 560. I'll write profit after tax. Tax ratio is 30%. So if I deduct 30%, profit after tax will be 70%. Or I can do minus 30, or I'll straight away do into 70. 560 into 70%. That will give me 392 is my profit after tax. In my profit after tax, first I'm supposed to pay money to my preference shareholders. So I'll pay preference share dividend. How much is my preference share dividend? 8% of 400. 400 into 8%. 400 into 8% should be 32. So 32 will go towards the preference share dividend. So profit available to equity shareholder is 360. Number of equity shares is 10 each, 1500. So I'll write 1500 lakhs divided by 10. That will give me 150 lakh. So this is also in lakh, this is also in lakh. If I straight away divide, what will I get? 360 divided by 150 will give me earnings per share of 2.4. So many of us will be having questions here saying, sir, there is dividend payout given. Yeah, dividend payout 70%. EPS 2.4 into 70% if you do, you will get DPS. And they have given what is a P ratio. Why the hell do you need all this? What they've asked is only earnings per share. Have they asked you to find market price per share? Have they asked you to find dividend per share? If they would asked DP per share, then I would have done 2.4 into 70%. If they would have asked market price per share, I know, right? P is equal to MPS by EPS. So I would use that formula, substitute. 25 is equal to MPS divided by 24. So 25 into 2.4. So somewhere around 50, 60, 50, between 50 and 60 is my market price per share. But what they've asked in this question is only EPS, and my EPS is 2.4. So answer for question number 98 is 2 rupees 40 paisa. Yep, come on, let us mark this. 2 rupees 40 paisa. Option D is the answer for question number 98. Come on, let's do question number 99. As the following. So what are direct costs? Direct costs are the items which are directly attributable to the product, and we can see it and then identify on the face when we see the product. Raw material is a direct cost. Showroom expense is indirect cost. Drawing office expenses, indirect cost. Carriage inwards, to bring the goods inside, direct cost. To take the goods outside, indirect cost. Preliminary packing, direct cost. Production wages, direct cost. Oil and grease, indirect cost. You cannot basically see. So direct costs are 1, 4, 6, 7. 1, 4, 6, 7. 1, 4, 6, 7. This sounds correct, but is part B correct? 2, 3, 5, 8. 2, 3, 5, 8. Yeah, option A. Option A is the answer for question number 99. Let us now go to question number 10. Sorry, question number 100. According to behavioral analysis, the overheads may be classified as, okay, overheads can be classified as fixed, variable and semi-variable. This is for behavioral analysis, how they behave. Fixed cost is fixed irrespective of level of output. Variable cost is basically varying depending upon the output. Semi-variable is a combination of both. So the answer for question number 100 is B, fixed, variable and semi-variable overhead. So this is with respect to discussion on entire 100 questions that we have in the paper of corporate and management accounting. So thanks for being there throughout, and it was really nice teaching you people for all these days. The day has finally come, the last day of our class. Yes. Yes. If you can note this point, we have not taken 3 hours to solve entire 100 questions. So definitely this paper can be solved by you in the exam. Me with detailed explanation, if I can do it in less than 3 hours, you can definitely do this paper in less than 2 hours in your examination. So falling short of time is not the reason that you can give. We have the discussion on mind and the energy within us. Only thing that's stopping us is the reasons that we give every day. Fly ahead and then do achieve your objective, and then trust me, all these reasons that you give will be part of the speech that will give on the day when you actually stand tall on the success mountain. And that's it for today. I hope you had little fun, and I hope you learned little new things today. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you guys are learning something new or having fun, it's all good. That day you guys either stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So the thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, are we in the game is my question. And shout out your answer loud to yourself. Wishing you all the best in the future. And my only prayers with you is, may the best of your past be the worst of your future. And entire world is in your hand, and it's about you as to how great you do out of it. I'll definitely include you in my prayers, and I'll wait to hear about your success in the coming days. And your 2020 examination paper or any exam that you'll write in further will be definitely the way you will solve this paper right now. So you'll be doing with same amount of confidence, and I'll be there with you remotely. Thank you. Bye-bye. Take care. Yep. As a part of addressing the messages that you sent on WhatsApp, few of them asked me to tell a story before I wind up this particular session. So here I am telling the last story for this particular batch. So it basically runs like this. This is the conversation that will happen between Rama and Ravana during the last part of our Ramayana. So what really happens is Rama goes in search of Sita, is what we all know. And then when Rama reaches the Lanka, and then before starting the entire war, Rama as a person wanted to perform puja before he starts the war. But Rama finds it not qualified enough to do the puja because he's from Kshatriya Vansha and is not from the, Brahmin ones. So basically he wanted a Brahmin to perform the puja before he starts the war. So everyone in the troop will be searching who exactly is a Brahmin who can do the warrior, who can do the puja before the warrior. Then Rama comes out with an amazing solution saying that Ravana, who better than Ravana to perform the puja before they basically wage the war. But Ravana is in the opposite clan. How can you invite Ravana to come and perform the puja? But Rama doesn't want to miss out on an opportunity here. Rama calls his very dear friend Hanuman and then asks Hanuman to go to the Ravana's place and then invite Ravana to come and then particularly perform the puja so that they can start the war. So Hanuman takes this message and everyone in the troop is surprised here hearing to Rama asking Ravana to come. When Hanuman enters the court of Ravana, everyone was so surprised to see this monkey come back after putting the entire state on fire. So they expected Ravana to kill this monkey. But Ravana wanted to hear out to Hanuman because Hanuman here is the messenger. And he wanted to stand by his ethics and stand by his professional responsibilities. When Hanuman comes and then stands in front of Ravana, he stands out and then tells the message saying that, my boss Rama is invited you to perform the puja so that he can start the war. Entire court of Ravana was taken by a shock here because they didn't expect Rama to invite Ravana to perform puja to kill Ravana all by itself. So no one expected. And the entire court expected Ravana to say no to this. But Ravana was not the person who will go by the expectation of people. He gave a surprise to everyone saying that, yes, I would come with you to Hanuman. People were shocked. People started asking, boss, what are you doing? Why should you be going to help Rama in this particular activity? He's planning the war against you and you should not be performing puja on his behalf. Ravana told, I am a Brahmin first and then I am a Brahmana first and then a Kshatriya, and when someone invites me to perform puja, I cannot deny this fact that I have to help them out in this particular puja. So I have to stand by my responsibilities and then fulfill it. So he takes his crown down and then keeps it on the throne and then he starts walking. Then the army starts walking with Ravana. And then Ravana says the army saying that, here I am going to Rama as a Brahmana and I am not like a Kshatriya and I am not your king anymore. So you should not be walking with me with this activity. So you stay here and then I go. Then the army was shocked because what if Ravana enters the Rama's troop and then Rama kill Ravana completely here and then take the Sita away. So people were surprised. But Ravana walked there to perform the puja. When Ravana walked there, entire troops of Rama were looking at Rama and then waiting for the message here from Rama. Rama, you just tell yes and we will kill Ravana here. But Rama told them not to because the reason here is the Ravana is a guest here and he should be respected with all the honors and should not be harmed when he is in Rama's troops. So it is Rama's troops' responsibility to send back Ravana, healthy and tight. So Rama asked Ravana not to be killed. Then Ravana comes there and he takes care, looks at the entire procedure of happenings. And then when you are in your enemy troops, you basically work with a little fear. But Ravana was not at all with fear here. In fact, he started identifying mistakes in what the Rama had planned. He started saying that is wrong, this wrong. Everyone in Rama's troop was pissed. They wanted to tell Ravana that you are in your enemy's troops. Better remember that. Yeah, but nobody cared to, or nobody dared to. Yeah. Then finally, when the puja, everything was set for the puja, and Ravana was about to initiate the puja, Ravana looked into the eyes of Rama and then he told him, you are ineligible to perform this puja because you being married, your wife is half of your and only half of you can't sit. You have to sit with your wife to perform any sort of this kind of a puja. Rama along with the rest of them here were taken by a shock by this point made by Ravana, because how can you stop someone and then blame them that you can't perform puja because your wife is not here? If you go back in the story, Rama wanted to wage a war against Ravana exclusively because Rama's wife was abducted by Ravana. And now in order to perform a puja to wage the war against Ravana, Ravana is complaining that Rama doesn't have Sita next to her. Then everyone wanted to kill Ravana at that particular moment. But Rama acted wisely. Rama started talking to Ravana saying that, boss, you are a noble man. When you identify the mistake, you being a man of such great moral ethics and knowledge, it is your responsibility to help us find the solution now. So now Ravana is responsible for solving this question because he has the answer with him. So Ravana came out with a very unexpected answer here. Ravana told, yes, I will go back to my kingdom and I'll bring Sita here and let you perform puja along. Then Rama was taken by shock. How can he do this? But Ravana told, you should let me take Sita along with me back to my kingdom. That was something very surprising. Nobody expected Ravana to say that. So Ravana goes to the kingdom, takes the Sita and then comes back. In between, people of Lanka along with the troops and ministers stop him. Boss, you're taking Sita with you. What if they kill you and then take the Sita away? Then Ravana told, no, it is my responsibility and I'm abiding by it. And then Ravana brings Sita and the entire puja is performed. At the end of entire puja, everyone from Rama's troops is like waiting eagerly for Rama's sign that, okay, kill Ravana, take Sita, let us go back to Ayodhya. But Rama doesn't give that signal. In fact, he asks the people to calm down and then treat Ravana with great respect. At the end of entire puja, Rama and Sita fall on the feet of Ravana. Ravana gives them a blessing and then says, Vijayi Bhava, meaning may the victory be yours. Now people were taken back by surprise once again by the kind of words used by Ravana. Ravana here told the Rama to be victorious. Rama being victorious means Ravana losing the entire battle here. But Rama cared to hear these words from Ravana, and Ravana in fact told these words because it was his responsibility. Now the victory will definitely be of Rama because Ravana himself blessed him with victory. Now at the end of this entire thing, Ravana told, this entire puja is incomplete because you have not given me any consideration. No consideration, no contract. Then Rama told, ask for whatever you want, my lord, I will definitely be able to serve you. People were shocked to hear what Rama just told because Rama shouldn't have used these words. Because if Rama says, ask for whatever you want, what if Ravana asks Rama to leave Sita and go? Then Rama has to leave Sita here and then go away. So, but Ravana was not such a cunning man. Ravana told that in my last times during this battle, if I end up dying in this battle, during my last few minutes on this planet, I want you to stay by me. I want to sleep on your lap and then die. That's the only thing that Ravana will ask for. So people were surprised because Ravana didn't ask for a bigger wish. Then the entire war will start and we know Kumbhakaran coming in, Meghanatha coming in and Bharata changing the troops and entire Vibhishna's trial, and we know the entire story. And at the end, when Ravana was shot by an arrow and Ravana is about to fall on the ground, entire Kapi Sena along with Hanuman, Jambavanta and Lakshmana, everyone is celebrating the victory. Rama remembers his duty. Rama runs straight away to where Ravana is about to fall, holds him in his hand and lets his head fall on his thigh, and then Ravana is now on the deathbed lying on the thighs of Rama. In this moment, Rama is fulfilling the promise that he made to Ravana. And in this moment, Rama looks into the eyes of Ravana and then asks Ravana, my lord, you are a man of great knowledge, skill, competence and qualifications. Yeah, there is no better man on this planet who is more knowledgeable than you. If you die, that is a great loss to the planet. Planet cannot take up that loss of knowledge, of wealth that you basically carry. So, I, as a honored or to say obliged disciple of yours, I am asking you, I am requesting you to please share the entire knowledge that you carry with you to me in this last minutes. So he's basically requesting Ravana to share the knowledge that he has. Ravana replies to Rama saying that, I don't have enough time to basically give you all the knowledge that I want. This is the last words of Ravana. Yeah, I would say inflated by me, basically. So these are the last words of Ravana to Rama. These are the last words of mine to yours. Yeah. So basically see it like Ravana is saying this to Rama and I am saying this to you. I don't really have enough time to tell all that I want to tell you. I don't really have enough time to teach all that I know you, all that I basically know. Or I don't really have enough time to teach all that you should be knowing in your life. But in the time that I have, if I have to tell you something, it is these last words and I give it to you. Things that are not good to you, excite you, pull you very eagerly towards them, and even you run madly towards it. I didn't want enmity with you, but that excited me. I came to you with reasons every damn time why to fight with you. So things that are not good to you, excite you, and pull you crazily towards them. In fact, even you run badly at them. Things that are good to you will fail to excite you, and you give very creative reasons why not to do them. So these are my last words and I give it to you. So these are the last words of Ravana to Rama and my last words to you, and this is the only message that I can give you, and I hope I filled enough of knowledge in the amount of time that I had with you people, and I seriously hope that I didn't waste any time of yours in the process of the entire course. And that's it. Have a great time and a great life ahead.